The market has been driven by what's happening globally.
We could break out to the low side on equities.
Broader risks to energy supply have to be monitored and likely priced.
Despite this jump that we've seen in oil, we are going to have that backdrop continuing around earnings growth.
The underlying fundamentals are still pretty positive, and people want to own this equity market.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Monday, oil hits triple digits.
We figured oil prices would go up, which they will. They'll also come down.
The oil is there. You're seeing a little bit of fear premium in the marketplace.
This is a short-term disruption for the long-term gain.
Key producers cutting output, sending crude through 100, pushing G7 officials to consider releasing energy reserves as neither the US or Iran is showing signs of backing down. We begin this hour with our top story. The price of oil surging following a weekend of escalatory strikes. Iran continuing to target several Gulf nations. Israel beginning to target energy infrastructure, heaping pressure on G7 officials who, according to people familiar with the matter, are set to discuss a possible joint release of crude reserves. That discussion happening later this morning.
And that's the reason why you're not seeing oil at 120 this morning. It has come down to about $100 a barrel, only a 10% gain versus something more in the line of 25% a gain in oil prices. Look, this has only been carried out 5 times before, this idea of a coordinated release. Twice in response to Russia's invasion of Ukraine in 2022. Before that, you had Libya, as well as Hurricane Katrina, as well as during the first Gulf War. This would be something that is a fairly rare step, but it highlights the sphere of disruption that you're seeing right now when it comes to such a key market and how this really does seem to threaten global economies.
This really is the only available offset right now. The only pushback we've seen, the only blinking, if we can call it that, from G7 officials. The president's not backing down. This quote from him over the weekend: short-term oil prices, which will drop rapidly when the destruction of the Iran nuclear threat is over, is a very small price to pay.
What's fascinating to me is that markets are believing that. If you take a look at the forward contract of oil, you can see that people don't expect there to be this prolonged bout of oil prices above $100 a barrel. It is priced in that by December, they'll be back down to $80 a barrel. People are expecting this to be over in a couple of weeks. The mechanism to trigger that end, that off-ramp, is potentially the markets, and yet the markets are not displaying a sense that there is abject fear of truly an economy globally that's going to get disrupted. So a real question about why this dissonance exists and how long it can continue.
It depends which market you're looking at right now, because if you check out the European bond curve, check this out. Over in the UK, yields up at the front end of the curve by 20 basis points. Similar moves across the continent as well. We're pricing out cuts, we're pricing in hikes at certain central banks.
Yeah, you didn't say hike, you said hikes. And that's because there are 2 rate hikes now being priced into the ECB in terms of the forward-looking calendar for this year. There is 1 hike being priced in for the Bank of England. So again, it's fascinating. Is this just a single mandate central bank where they have to look at inflation and counter that? At what point does some of the weakness that we've seen in a number of economies and what could transpire as a result of oil prices start to play into exactly how they respond?
We've thrown a lot of this market in the last week, haven't we? Just in an hour on Friday, an energy shock, a payroll shock, and another shock in private credit.
What struck me in the United States is how multifaceted people keep saying it is. How there are parts of the complex, whether it's oil, whether it's materials that'll benefit from this, that can offset potentially the shock to private credit or what we're seeing with respect to the economy. I just wonder at what point you see a pillar that shakes. At what point this is just people who don't want to sell their stocks because ultimately they don't want to have to buy them back at a higher price, and they have been conditioned by buy the dip, buy the dip, buy the dip, and suddenly they can't even recognize something that's staring them in their faces.
It's another Monday morning that started Sunday evening. Wild ride for crude. Equity futures negative just 1% on the S&P 500. Coming up this hour, we'll catch up with Cameron Dawson of NewEdge Wealth with global markets selling off. Henrietta Treyz of Veda Partners as President Trump downplays rising crude costs, and Subadra Rajappa of SocGen as inflation fears steer investors away from bonds. Our team coverage starts right now with Bloomberg's Jeannette joining us out of Dubai. Jeannette, welcome to the programme. What's the latest in the region right now?
Well, as you guys were saying, there are no signs at all that things are de-escalating and, if anything, intensifying militarily operations on both sides. I will say that the appointment of the new supreme leader is an act of defiance out of Iran. As you know, the son of Ali Khamenei has now been appointed as the successor, the third supreme leader of Iran. He's quite literally cut off the same cloth of his father, same ideology. He's perceived to be very close to the Revolutionary Guard Corps, the IRGC, very entrenched with the security establishment as well. In 2019, he was placed under U.S. sanctions and has also been accused of interfering with elections and being involved in many of those brutal crackdowns that we've seen on demonstrators. So, you know, if you tie it back to what President Trump was saying over the weekend, that he would like to see a full and unconditional surrender, this is not an appointment that would suggest that the Iranian regime or the Islamic Republic are looking to surrender or to yield to the U.S. demands anytime soon. At the same time, operations continue. IDF saying that they struck 400 targets over the last 24 hours. And Iran continues lashing back at Israel and at Gulf states. More than 2,000 projectiles have been fired towards Gulf states over the course of the weekend, since the beginning of the war, I should say. But over the course of the weekend, continue to target key sites and energy infrastructure. Just this morning, another refinery from the region in Bahrain also declared force majeure. They've had multiple attempts at targeting an oil field in Saudi Arabia. The U.S. State Department is now ordering non-essential personnel to leave the U.S. Embassy in Saudi Arabia. More intercepted missiles being directed at the UAE. Reports of a fire earlier in Fujairah as well. And then in Bahrain also, and this is one other point of escalation, a desalination plant was targeted. Now, it did cause damage, but the messaging from the authorities is that water supplies are still running. But again, it just really illustrates the amount of economic cost that the Iranian regime are looking to inflict, not just on the region, but on the global economy as well.
That right there is a highly concerning escalation over the weekend. Jemana, thank you. Jemana Basechi in Dubai. Just to build on what Jemana was talking about there, Iran doubling down on hardline leadership. And also reports over the weekend suggesting the president is considering a special ground operation as well.
Because the uranium is evidently still there in terms of the refined uranium that a lot of people were worried could get developed into nuclear weaponry. This is the question. How far is this president willing to go? And is that the red line, the ability of eliminating that uranium threat?
Here's the view on Wall Street this morning. Cameron Dawson of NewEdge Wealth writing the following. We expect equity market volatility to continue. Weakness is buyable. Gone are the days of low volatility and mount-up markets. Cameron joins us now for more. Cam, good morning.
Good morning.
Did you expect to see equities where they're trading this morning after the move overnight in crude?
Well, as of the close on Friday, we were a whopping 3.5% off of all-time highs. And so we wouldn't be surprised if this volatility continues. We see no sign of flush within markets. If you look at the technicals, breadth measures, percentage of names above their 50-day is still at about 42%. You haven't seen signs of indiscriminate selling, which just says that markets have taken this very much in stride. And this isn't the point yet where people are so scared, have so much fear that you want to back up the truck. So that just suggests to us, prepare for more volatility. Eventually, that volatility will create great buying opportunities when we see indiscriminate selling, but we're probably not there yet.
Why is this market so resilient in the face of not only an external shock, but also what we saw on Friday that everybody seems to be shrugging off, which is there seem to be cracks in the actual fundamental economy at the same time?
We think this is the big risk because if you look at 2026 and 2027 earnings estimates, they're expecting about 14% growth each year, which we don't think is consistent in an environment where you're not seeing job additions and you're seeing an oil price shock, because that's how this impacts overall consumers. That's the one way that conflicts end up impacting overall earnings growth. And so given the fact that you have very, very rosy expectations for both 26 and 27, I think that's one of the things that people are hanging their hat on for why this market can be sustained. But we actually think that there is downside risk to those estimates.
How much is the U.S. once again providing sort of the haven trade, given the fact that Europe is getting hit that much harder, that European stocks are actually in a correction from their February highs, that you see people flooding back into the dollar?
Well, you're seeing it certainly in the dollar. And it's important to note we went into this oil price shock and this conflict with the dollar positioning near record lows. So everybody was short the dollar. Everybody was underweight the dollar, which just suggested that the pain trade of the dollar was actually higher, which is exactly how this is playing out.
The three shocks that we've been tracking, payrolls, energy supply, private credit as well. Those redemption headlines that creep crossing the Bloomberg terminal, the accumulation of those risks, are they an index level threat or not? Because at the moment, the index is not doing much at all.
Yeah, I think that one of the things that we've seen over the course of the first 2 months of this year is what we were calling a risk swap market instead of risk off, meaning that people were swapping out of risks out of things like AI disruption into areas that were inherently risky themselves. Look at the flows into things like industrials and materials and energy, of course, which we know is a little bit of a different story. But people were still keeping this broader cyclical bid under the market. That's starting to deteriorate. That's why we're starting to see breadth begin to deteriorate. So we think it's really hard to justify spending 27 times forward on industrials in an environment where you're questioning forward growth.
What is left to anchor the bullish view, the bull case for the year ahead?
That this would be temporary. That's the one thing that keeps this as a bullish view, is that the price spike higher in oil ends up being something that is incredibly short-lived. I think the challenge we have is that even if oil comes off of its highs, it's unlikely to return to where it was before, simply because of the destruction that we've seen to the infrastructure. Also remember, back in 2022, oil prices spiked and hit their high just a few weeks after the Russian invasion of Ukraine. But gasoline prices didn't peak until the summer, meaning that we saw gasoline prices go to $5 a gallon. We saw overall headline U.S. inflation hit 9%. So we could have an environment where WTI comes off of its highs, but it still pressures U.S. consumers because gasoline prices would continue their march higher.
How long do we have until the moment in markets? The whole sort of this question of what are we going to see going forward? Polymarket has a 46% odds right now of a U.S.-Iran ceasefire by April 30th. I assume that will be devastating in terms of the timeline if that were to bear out.
Yeah, I think that is a very long way away. And each and every week that goes by with oil prices and gasoline prices, which are now up on a year-over-year basis for the first time in 3 years, this is important. Remember the fact that over the last 3 years, we've been in a disinflationary environment because of falling oil prices. We've had a boost to consumers because of falling oil prices. So 2 months forward of oil prices at these levels will certainly start to weigh on GDP estimates. And remember, risk assets do not like falling growth estimates. And we're starting this energy price shock with growth estimates for GDP at 2.5%, pretty fulsome. And again, back to EPS, which are really high in that 14%.
Cam, it's always good to catch up. Thanks for being here. Cameron Dawson there of NewEdge Wealth. No rest in this market right now. Futures negative by about 1% on the S&P 500. This from Jordan Rochester of Mizuho this morning. The market is waking up from its slumber, coming round to our view that this may be a war, but it's also perhaps the biggest energy supply logistics crisis we've ever seen in modern history. The latest from Mizuho. Talking about how currently $100 a barrel is where we are currently at. However, the longer this goes on, the greater the likelihood that it goes to $130 to $150 per barrel. And if that's the case, it's a very different scenario for global markets. How long does it take until we get there, right? I mean, how much can people absorb given the fact that right now it seems like markets are saying, look, we don't want to be ending up with stock prices that much higher and being behind the curve and buying in. A massive gap higher that we saw in crude at the open overnight. This morning, we're up by double digits, up by 12% on Brent, 104 off the highs, on WTI, 101. Up next on the programme, a fair premium for crude.
We are suffering high prices, not in natural gas, but in oil, because it's a globally connected market. The oil is there. You're seeing a little bit of fear premium in the marketplace.
Up next, we'll catch up with Henrietta Treyz of Veda Partners, live from New York City this morning. Good morning. .30 Eastern Time, an important call with G7 finance ministers considering the release of energy reserves following some major moves overnight in the crude market. Check it out at the highs, pushing 120, 119.50. The high of the session on Brent right now, just short of 105, a move of more than 12%. Weighing on equity futures, futures down by 1% on the S&P 500. Likewise on the Nasdaq by 1.14. On the Russell, down by close to 2%, Bramo, so far this morning.
Yeah, the Russell being slammed on a couple different fronts. Not only do you have a question question of oil price sensitivity with consumers, but also a question of whether the Fed can cut rates. Well, the answer is, well, it seems less likely given the inflationary pressures. And it seems right now people are focused more on the inflationary pressures than weakness, seemingly coming from the underlying employment market.
The Fed between a rock and a hard place right now, that's for sure. Under surveillance this morning, a fair premium for crude.
We are suffering high prices, not in natural gas, but in oil, because it's a globally connected market. We're communicating with our allies abroad. The oil is there. You're seeing a little bit of fear premium in the marketplace, but the world is not short of oil today or natural gas. We are nowhere near normal traffic right now. And, that'll take some time. But again, worst case, that's a few weeks. That's not months.
So here's the latest this morning. President Trump saying oil surge is a very small price to pay as hopes fade for a quick resolution to the war in Iran. G7 ministers set to meet today about the possible release of emergency oil reserves. Bloomberg's Tyler Kendall joins us now from Washington for more. Good morning, Tyler. Where's this one going?
Yeah, hey, John, good morning. Well, at this point, it appears that the administration is trying to downplay the spike in oil as the U.S. Energy Secretary maintains this will not be a long-term conflict. And we've heard from other U.S. officials framing this as a short-term disruption for the long-term gain of the U.S. trying to achieve its goals in Iran. The thing is, we haven't seen any intent or notice that there's going to be a diplomatic off-ramp anytime soon as major Middle East producers curb production. The Strait of Hormuz remains effectively closed, and the White House is now threatening to widen the conflict. In a post on Truth Social over the weekend, President Trump said that the U.S. is now considering striking other areas and groups of people in Iran not previously considered to be targets, though he did not elaborate. So far, it appears most of the strikes have been targeted against government and military sites rather than a full-scale bombing of infrastructure. Secretary Wright made that point when it came to energy infrastructure, though Israel did hit several Iranian fuel depots over the weekend. And in another potential escalation, Bloomberg News now reporting that President Trump is weighing a special operation to go into Iran to extract its highly enriched uranium stockpile. John, as you well know, this White House is already playing defense when it comes to affordability concerns, and those prices are starting to trickle down to retail gasoline. And you mentioned one of those potential options to help curb those costs as G7 finance ministers meet later today to discuss a strategic release of reserves. This would only be one of 5 times that this has happened before, though people familiar with the matter do caution that no decision has been made.
Tyler Kendall with the latest in Washington, D.C. Tyler, thank you. The words of the president, short-term oil prices, which will drop rapidly when the destruction of the Iranian nuclear threat is over, is a very small price to pay. For many, it's a high price to pay. Henrietta Treyz of Veda Partners writing fears of $4 gasoline are being pulled forward. Republicans, including in the White House, are scrambling to contain the fallout. Henrietta joins us now for more. Henrietta, welcome to the programme. What signs, what indication do you have that anyone's scrambling to contain this?
Well, they're doing the Lord's work trying to present a calm front on the outside. The president is down in Doral, Florida this week talking about an elections reform bill that focuses on mail-in ballots and transgender sports issues. So they're trying to project calm and talking about this being transitory. But when you're already just on day 10 of any kind of military engagement, we're already talking about a $50 to $150 billion emergency supplemental spending package. That is your indication that we have upended the legislative agenda. We will not be getting a crypto bill. I don't think we'll get a housing bill. It's going to be either all Republicans, reconciliation bill, spending money to address this war, or bust. And that's the agenda that they're going to be talking about below the surface today and this week in Doral.
Henrietta, how united are Republicans behind President Trump when it comes to this war?
Not very. You're seeing a lot of consternation. It's very public when it does come out. It's mostly led by the usual suspects. Thomas Massie of Kentucky is a Republican who is being very blunt about his opposition. And you're seeing the breakdown. What I would recommend is look at the way that the Republicans are responding to the president's entreaties to repeal the filibuster to pass the SAVE Act on that elections package. There's just not support there. Leadership can't pull it off. So when Speaker Johnson says we're going to prioritize the reconciliation bill, it's because members behind the scenes are saying, if we're going to wage this war, if we're going to stick behind the president on this, we have to get spending out the door. It needs to go to farmers, $15 billion for the second bailout because, of course, we're dealing with the fertilizer impacts from the Strait of Hormuz. And we also need to do something to bring prices down as we go into the November elections.
It seems like markets don't believe the calm being projected from the White House. And they do think that at a certain point, prices rising and some of the distress will pressure this White House to capitulate. Are there any signs that pressure from Republicans and pressure from the oil markets is starting to affect any of the strategy coming from the White House?
Well, I think that the actions that we see from the White House on tanker insurance, on letting it be known that there will be an emergency supplemental request, on letting it be known that there'll be a second farmers bailout, that's indication that they recognize there has to be some give on this. When the president does his military campaign, though, that is largely outside of their control. And that's, I think, where we're seeing the headlines shock the markets every single day. You know, I was speaking with investors last week who were saying this will be wrapped up by Friday. Well, here we are on Monday, crude spiking through the roof in the fastest ever growth. And you have to readjust your expectations, reset. The SPR release or the G7 release of strategic petroleum reserves is helpful today. But you need a wide ranging sort of bazooka to address a shutdown of the Strait of Hormuz, which is where we are right now.
Henrietta, as you mentioned, that call takes place at 8:30 Eastern Time between G7 finance ministers considering discussing the potential to release those reserves. There is a much bigger question, I think, for the US specifically. Why the SPR wasn't refilled ahead of this moment?
Especially when gas prices were so low. It's a major strategic blunder. And you have to question, was the president prepared to go into this war and recognize that the strait would be shut down? What did they think was going to happen? We had a year of very low energy prices. Indeed, it was the highlight of the president's economic agenda to have gas prices low, and you could have refilled the SPR. And instead, he chose not to. It just suggests that they did not have their ducks in a row when they went into this, and now we don't have the SPR filled. It's at very low levels. And of course, even when you do release the SPR, it's heavy crude that needs to be refined. It's not going to immediately fix anything. It makes you feel better, perhaps, but it's not going to fix anything in terms of $4 gas coming our way.
I think many people tracking this market are asking the same thing. China managed to stockpile energy over the last 12 months. Why didn't the US, when it was the US that was deciding to engage in this conflict or not? Then these headlines as well from the Treasury, Henrietta. I want your thoughts on this. This from Secretary Bessent. To ease the temporary gap of oil around the world, we've given them permission to accept the Russian crude. Talking of India, we may unsanction other Russian oil. In essence, by unsanctioning them, Treasury can create supply. What's your response to that?
Well, I think it's just further acknowledgement that they were not prepared for this. They've spent all last year putting sanctions on India, on Iran, on Russia. They have, don't forget, they're supposed to raise tariffs under Section 122 to 15% this week. The White House has a completely disjointed agenda from the energy components to the tax components to the tariffs. And they're trying to, as I said before, cover every single base because there's nothing you can do with one silver bullet that will fix this problem. You've got to do everything. So if that means taking Russia's sanctions off, releasing the SPR, ensuring oil tankers, providing a farmer's bailout, you need to do every single one of those things at once in order to keep gas from getting to $4. And that's where we're headed.
Henrietta, how much do you allow the U.S. to keep exporting LNG to Europe, given the fact that natural gas prices in the U.S. are also going up? I mean, do you expect that to be a conflict?
It's definitely a tension point. We've seen this movie before. You know, when I think of the Russia-Ukraine war, I mean, this is something that I think the United States ultimately is happy to have a conversation about, getting LNG over to the EU, making them a little less dependent on Russia, on oil sources that we prefer them not to go to. So I think that this is a tried and tested path of trying to deal and resolve with that tension.
Henrietta, always good to catch up. Thanks for being here. Henrietta Treyz there of Veda Partners. This conversation follows our conversation with the National Economic Council Director on Friday, following the payrolls report. Asked him specifically about the SPR and whether there was an active conversation about releasing any energy from those reserves. And the answer was no. And it was pretty direct, and he didn't dance around the issue. Many people asked that question over the weekend. How did we get here without refilling the SPR? And yes, the previous administration has a lot to answer for, but this is the one that's decided to go and engage with Iran in the way it has done.
And we had pretty low oil prices for quite a long time, with people saying refill it. Just to give you a sense of how low it is, the U.S. SPR, the Strategic Petroleum Reserve, has about 21 days worth of consumption. That is the lowest in decades. It raises a question, even if you were to release it, how much oomph would it have to really lower prices in a longer-term way?
Triple-digit crude this morning, up by 12% so far intraday. Up next on the programme, Joyce Chang of JPMorgan as markets react to soaring crude prices. When does demand destruction kick in. Joyce is coming up next. Plus, Lizzie, how's your morning movers? Energy stocks moving higher with crude prices hitting 100 plus. Exxon up by 0.8. Occidental Petroleum up by 1.4. From New York City this morning, good morning. You're watching Bloomberg TV. Two-day losing streak on the S&P 500 about to become day 3. Equity futures negative 1% on the S&P, well off session lows. On the Nasdaq, we're down by 1.2. On the Russell, small caps underperforming, down by 2%. The main event, the epicenter of the price action worldwide, this right here. Energy, Brent, WTI. Brent crude up 28% last week, up 29% overnight, and off those highs now up 13 to 105. The spillover into the bond market very clear. Yields higher across the curve. Stateside, much more worldwide. 2s up by 5 to 360. 10s pushing 420, up by 4 basis points this morning.
As you said, it is a lesser move than what we're seeing over in Europe, where suddenly you've got 2 rate hikes being priced into the market. The reason is twofold. On one hand, the U.S. economy is more resilient naturally, is also an oil exporter. The European region is more sensitive to these oil price shocks, as well as it is a single mandate central bank. They have to respond to inflation primarily, and that is the reason why people are looking at a very different path ahead for them.
The tightening of financial conditions worldwide, higher crude prices, higher bond yields, pricing out easing and pricing in the prospect, the real potential of rate hikes. As we count you down to the opening bell, about 3 hours away, let's get you some single names, some morning movers. Lizzie Burden has more. Hey, Lizzie.
Hey, John, we have to start with the oil story. As you say, oil above $100 a barrel. So take a look at the energy names. We've already seen gains in the Europe session for the likes of BP and Shell. We've seen gains for Saudi Aramco as well in the pre-market. ExxonMobil, Chevron, Occidental, all in the green. Aside from energy, there aren't that many winners to be found in the pre-market, but Hims & Hers is one of them, up nearly more than 50% in the pre-market on the news that its public feud with Novo Nordisk is at an end. Novo agreeing reportedly to sell its weight loss drugs on the Hims platform. But don't forget, about this time last year, they reached a similar agreement and it fell at the 11th hour because Hims reportedly didn't want to stop marketing and selling its own copycat medication. So will this deal get over the line? Traders looking optimistic that it will. Just finally, let's turn over to Live Nation. We had a redhead crossing the terminal earlier on that it was nearing a settlement with the Department of Justice on the antitrust trial that had been going on. Of course, the accusation is that Live Nation is illegally monopolising the live music industry, and this concern goes all the way back to the Obama administration, which had allowed Live Nation, of course, to acquire Ticketmaster. So the settlement discussions heating up since the trial started on March the 2nd, and we report that that could be announced in the coming days. Shares up more than 5% in the pre-market, John.
Lizzie, thanks for the update. Appreciate it. Lizzie Burden there out of London this morning. On our radar this morning, the price of crude breaking through $100 a barrel for the first time since 2022. G7 finance ministers preparing to discuss the joint release of reserves as the war with Iran continues to disrupt energy flows. Elsewhere, Iran announcing its new supreme leader, signalling the country would not back down from the conflict. President Trump denouncing Tehran's choice of the hardline son of Ayatollah Ali Khamenei as unacceptable. And finally, White House Press Secretary Caroline Leavitt dismissing concerns over rising crude prices, insisting that President Trump's energy dominance strategy will stabilize markets.
With respect to what's happening with gas prices right now, this is a short-term disruption for the long-term gain. We're seeing a slight increase in oil and gas prices, but ultimately taking out the rogue Iranian regime is going to be a good thing for the oil industry, and those prices are going to come back down.
The president posting on social media that the crude spike is a, quote, small price to pay for safety and for peace.
Getting the population as well as fellow Republicans on board with this is going to be somewhat more difficult. Interesting that it seems like there is a timeline. You were speaking with the National Economic Council Director, Kevin Hassett, on Friday. He said that there was a timeline. He wasn't going to disclose it. I'm very curious about that. Is this calm reflecting some sort of timeline that has a short leash, or can you get out of it in that type of time? I think that's the concern, given how it has been escalated.
This phrase you keep hearing, ahead of schedule. implies there is a schedule. It's the question I asked. Of course, they're not going to share us the schedule, even if there was one. But reports over the weekend suggesting that they're still considering a special operation, a ground incursion, to secure uranium tells you that maybe this plan isn't fully secure.
And it goes to the question of what is the ultimate goal? How fungible is it? Is it just a question of de-arming Iran? What does that look like? De-arming them currently or de-arming them in the future, given that enriched uranium is still missing? And supposedly reports over the weekend talking about how there still are pathways to go retrieve some of that enriched uranium, which clearly has gotten the concern of the White House.
Feels like the goals are moving in real time, that's for sure. Crude's moving in real time, 105 on Brent, WTI just north of 102. Surging crude prices driving stagflation trades worldwide. Joyce Chang of JPMorgan writing, we expect volatility to remain high in the near term, putting upward price pressure on oil and gas and impacting inflation and impacting growth. Joyce joins us now for more. Joyce, good morning.
Hey, good to be here.
Is that a stagflationary shock?
Well, I mean, we've run two different scenarios at JPMorgan. We've looked at the spike that we've seen to 120, but does it settle at 80? And then you take about 0.5% off of growth, you add 1% to inflation, but you don't necessarily stop the global expansion. But oil at 120, you take a full 1.2 percentage point off of growth, you have inflation risks that are higher. And, you know, we don't see the off-ramp yet, so the risk premium here is going to stay high, I think.
What did we learn in 2022? When we had a similar move? How different is this economic backdrop?
Well, I think that this economic backdrop is different just because the prospects for regime change, the off-ramp, the negotiation process is not there. But you also see that some of the oil infrastructure is beginning to be hit right now. So I think that there are some commonalities to 2022, but we also have to just look at the fact that we are in a situation right now where we're only a week or so into this, and we were going into year 5 now and looking at what has happened on some of these other conflicts which haven't been resolved. So the market is looking for just what the off-ramp could be.
And right now they're almost counting on an off-ramp they can't see. Oh, how do you explain the market's relative, I don't want to say complacency, but resilience in the face of a shock that could be quite damaging?
I think there's a sense that this level of bombing cannot be sustained, even though you could have, similar to 2022, like a very long slog ahead. There's no doubt about that as far as just what this conflict means over the longer term. But can this level of bombing be sustained? And I think that the key issue that everyone is looking at right now is that what are the options here? So there's the G7 emergency meetings that are coming up. There are the questions about just how you make sure that more oil isn't taken off of the market. And we think that about 3.5 million barrels per day have been impacted.
So there is this question of the effect on growth, as you were just talking about. Should oil remain above $100, $120 a barrel? There's a question about the momentum the U.S. economy had going into this. I was really struck by how many people shrugged off the labor market report that we got on Friday or said it doesn't fit with other data that we've gotten. It doesn't really represent weakness in the underlying U.S. economy. Do you think some of the strength has been overstated?
Well, look, we have been looking at the labor market weakness for some time right now, not just the AI disruption, but the impact of lower immigration as well. And we just haven't seen that much labor demand that's there. So I think the sticky inflation, the fact that you've had the labor market weakness, some of the retail numbers that came out were also showing signs of weakness as well. So it's a time to look at the risk premium to stay elevated and to put more hedges on, I think.
Governor Wald is clearly voting for a rate cut at the next meeting based on what he told us, and it looks like the strength we saw at the start of the year is looking like a bit of a head fake. Is he going to have some company at the next meeting?
We have been out of consensus. We have not had rate cuts in our forecasts, even before this occurred. And we just felt that the inflation numbers just did not point to that. So we see that this on hold, being where the market is going to have to stay, just given the macro data that's coming out.
Outside of energy, what's the source of inflation?
Well, I mean, I think you still have very sticky prices, that have not come down. I mean, we're at year 6 of not hitting the inflation target. So this is not necessarily new news, but the case for rate cuts isn't there. Now there's much more concern about the stagflation risk, given the questions about what the economic growth forecasts will be.
We've been talking about these three shocks, and John laid them out earlier in the show, the idea of, on one hand, the oil price shock, that's the most recent one. Then, of course, you've got the AI shock and questions with that. And then, of course, you've got the private credit, which is sort of intertwined with AI. With respect to AI, you think that that has already been played out, that we're not going to necessarily have those concerns that continue to mount, and that we're going to go back to some of those sort of feelings of confidence in the technology. Why do you think that's the case?
Well, I think, look, the CapEx growth numbers for AI still remain very strong. I mean, we had started the year thinking it'd be, north of 30% for the Mag 7, actually raised that. Even if it comes down, so you have very strong CapEx growth that is in motion right now for AI. And the AI adoption is still underway. So I would sort of put that story, not merge all three of these stories that you put together. I think private credit is not one that we see as systemic. At this point, the AI, it seems to me that you're probably past the worst of the concerns on the software. And we've been overweight software versus semis, which has played out. But it's a period where we do think that being in investment grade credit makes more sense than being in equities right now.
At what point do high oil prices pressure these other stories? Whether it comes to AI and the energy consumption, or whether it comes to private credit and the need for the consumer to keep having discretionary spending power?
So it depends on whether this is a short-term shock. If we see oil settling at 80, I mean, it's 0.5% off of growth, it's 1% higher in inflation, but it doesn't necessarily break the global expansion. If you see oil staying at these levels and persisting through the middle of the year, that's when you really have to talk about, a much more serious markdown in the forecast.
Joyce, it's good to see you. Thanks for dropping by.
Great to see you.
Joyce Chang of JPMorgan there on the energy market and what it means for this economy. It is a major energy shock, a move from the 70s, in the 60s not so long ago, and into the 100s, triple digits and pushing 120 overnight. A major move at the open in Asia.
It was the biggest move ever last week when it comes to WTI, the biggest move since the 1990 Gulf War when it comes to Brent crude. A question of what can some of the global powers do to mitigate this? Is it really just tapping their SPRs? Is that going to be enough to stave off this shock? And then once those are used up, then what?
You've got to show a path to de-escalation to get this market to de-escalate and reprice crude lower. And right now, I don't see one on either side.
Well, and there is this issue of, has this conflict taken on a life of its own? When you have different powers attacking one another's oil resources, the desalination plants, that was a very big concern for a lot of people over the weekend. This is how people get drinking water. This is the classic infrastructure that allows people to live in a lot of these countries. That starts to get attacked, a very different scenario emerges.
Futures this morning in the equity market, negative just 1% on the S&P 500, even with some major moves in the commodity market. Let's give an update on stories worldwide. Here's your Bloomberg brief. Iran picking the son of Ayatollah Ali Khamenei as its new supreme leader, the 56-year-old taking over from his father, who was killed in an attack by the US and Israel. The president saying he's unhappy with the appointment. Elsewhere, crude nearing 120 a barrel this morning before pulling back on a report of a joint release of emergency reserves. Sources telling us here at Bloomberg that G7 ministers are set to discuss the release at 8:30 Eastern Time. The US is said to support the idea. And finally, an IED was thrown outside of the New York City mayor's mansion in Manhattan. The violence erupting during an anti-Islam protest. The protest drawing an even larger crowd of counter-protesters who were accused of throwing the explosive device. 6 people were arrested and the FBI is launching a terrorism investigation. That right there is your Bloomberg brief. Up next on the programme, a stagflationary shock.
As with any supply-side shock, it can lead you in a stagflationary direction. There's not an obvious monetary policy answer to a stagflationary shock.
Subadra Rajappa of SocGen joins us next, live from New York City. You're watching Bloomberg TV. What a move in energy overnight. What a move this morning. Overnight, The high 119.50, up by 29% after a 28% gain through last week. The kind of moves that follow major shocks. The energy shock of 22, the pandemic of 20. This its own beast, and a beast it is. WTI 103, Brent crude 105. In the equity market, pulling down equities right now across the board. On the S&P down by 1%, on the Nasdaq down by 1.2, on the Russell down by 2 percentage points, and worldwide triggering a bond market sell-off with yields higher across the curve stateside. 2s, 10s and 30s look like this, up by 5%. The 2-year at 361. That is nothing compared to what you're seeing developing in places like the UK.
Where suddenly you have one rate hike being priced into the Bank of England forecast for the year ahead in terms of where things are trading. Look, what we have seen in terms of the market response has been that the rest of the world is much more exposed to an energy shock than the United States is. That's a reason why you see European stocks falling into a correction from the February highs. That's the reason why the Kospi has been trading out of bed, because people seem to think that this is sort of the risk asset of choice when you go outside of the U.S. And it raises questions. Is it actually going to be borne out in the economy, or is this just simply a knee-jerk reversal of some of the consensus trades?
9 basis point move at the front end of the German curve. 25 basis point move at the front end of the UK curve. That is brutal. If you're looking for some kind of offset to comfort consumers right now, you're not getting it with rate pricing at all.
Honestly, the United Kingdom has an even more difficult scenario ahead of it than the ECB, than the European region, because on one hand, you've got a weaker backdrop economically at the same time that you have a very sensitive household to energy prices. So you get a double whammy. On one hand, borrowing costs are going to be tightening at the same time that you also are going to be having higher bills. This is the stagflationary shock that nobody wants.
And this is the headline we did not want to see. Saudi Arabia starting oil output cuts as storage fills up. If you can't move the energy through the Strait of Hormuz, you have to put much of it in storage. And once you breach capacity, you have to start cutting output. We saw it with Iraq last week. With Kuwait into the weekend, UAE followed, and this was the major headline we've been waiting for. Saudi Arabia starting to cut output as they start to hit storage capacity.
People keep reminding us you cannot just turn back on these supplies. It's not a switch. It's actually a complicated process that takes time. When you start shutting down oil output, that prolongs the period of time until we can normalize. And that is the reason why you get a response that continues to expand as we get these headlines.
That's the breaking news this morning. Brent crude high by 14%, 105.64. WTI 103.20. Under surveillance this morning, a stagflationary shock.
As with any supply-side shock, it can lead you in a stagflationary direction, which is to say the inflation side of the mandate getting worse. At the same time, the employment side of the mandate is getting worse. There's not an obvious monetary policy answer to a stagflationary shock.
So here's the latest this morning. Global bond yields rising as the Iran war stokes fears of higher inflation and lower growth. Subadra Rajappa of SocGen writing, we do not expect this positive correlation between stocks and bonds to persist. A stagflation-like environment argues for policy on hold. Subadra joins us now for more. Subadra, good morning.
Good morning.
Is there a tipping point where this becomes bullish for bonds and not bearish?
It's not going to happen anytime soon, it seems like, because of the fact that you have this sort of move in global bond yields, and global bond yields are moving quite dramatically higher. As you noted earlier, gilt yields are higher. You're seeing higher yields in New Zealand and Australia. So this global bond yields moving higher is going to keep treasuries higher as well. But I just don't see treasuries really breaking out of the range on either direction. So yes, it's not a good flight to quality hedge in this environment, because typically when you tend to see stocks sell off, you see investors move to the safety of bonds. But I also don't see treasuries really moving out of the ranges that we've been in the last few months.
So how much of a decoupling are you expecting then with the US versus the rest of the world? Because we're seeing some big moves developing in the UK and elsewhere this morning.
Yeah, the US is energy independent. So a lot of this story here in the US is more a delaying of the timing for the easing. We're still priced in for close to 2 cuts for this year. So there's not really a big change in the outlook for the Fed. That's not the case in the rest of the world, with the Bank of England as well as the expectations for the ECB have not only switched from easing, the market's now pricing in for hikes. So this is a pretty dramatic change in the outlook for central banks. So for the US, I would say it's more of a stagflationary environment. The Fed doesn't do anything. It translates into lower growth. We were already looking at very, very strong growth for this year coming into the year. If anything, we're going to get lower growth, but it's not a really dire situation. That's why I think Treasury yields remain somewhat range-bound.
Do you think that the long end of the U.S. yield curve is rising because of rising inflation expectations over the longer term? Or do you think it's just in sympathy with the rising yields elsewhere, maybe in Japan or in Europe?
I think it's more in relation to what's happening globally. If you look at inflation expectations, yes, they're rising. They're rising more in the very front end. That's what you should see in an environment where it's expectations that are being led by higher energy costs. If you look at the 5-year forward, 5-year break-even, which is what the Fed looks at, it's actually been coming lower because 2-year and 5-year break-evens have actually been going higher. So that actually says that the Fed is going to be credible regardless. So it's not an inflation expectation story for me. It's more a story of what happens over the near term with crude oil prices and higher sort of front-end break-evens.
If we were in a vacuum, and we looked at some of the inflation prints, we're going to get CPI and PCE this week. That would have been really important just to understand how much the Fed could cut after Friday's non-farm payrolls report. We would have been talking about the significance of rate cuts. Why is everyone shrugging off the jobs backdrop that looked pretty weak on Friday and just focusing purely on inflation going forward?
Because it's just one print. If you look at the 3-month averages, it's still relatively strong. Yes, if you look through the details of the labor market picture, the labor market has been very much in stasis. So yes, am I concerned about the labor market? Yes. But that said, I think that the bigger concern for me is on the inflation side. The Fed has eased 3 times last year, 75 basis points of preemptive cuts. The job market remains relatively stable. We are looking for cracks. But for the most part, I think the focus is going to be much more on inflation. Coming into the year, it was about tariffs. It was about the feed-through into goods inflation, maybe food inflation, and tariff-related concerns. I think we're still at peak uncertainty on tariffs. So in that sort of context, now you throw in the dynamics with higher oil prices, that really changes the outlook for headline inflation. So the Fed is going to be very, very focused on what happens on the inflation side while paying attention to the labor market, but I think inflation is going to take priority.
How do you think the outlook's changed with triple-digit crude? At the moment, we've been closer to 3 than we have to 2 on inflation. Are we getting closer to 4?
You know, it's going to be transitory. I hate using that word. For the most part, the Fed is going to be willing to look through spikes in oil prices, especially if you look at the last, 2.5 decades of geopolitical events. These events tend to be somewhat near term, as in like they're short-lived. You see a spike in oil prices come down. We're energy independent, so that's not nearly much of a concern. So you're looking more across sort of what happens once we get through this sort of geopolitical concern as opposed to something that's going to be long-lasting. So that's part of the reason why I think the market tends to discount spikes in oil prices.
Subadra, always good to see you. Thanks for being here. What a start to the week. Subadra Rajappa there of SocGen on the bond market. This headline crossed on a Bloomberg terminal just moments ago. This from our team here at Bloomberg News. Saudi Arabia started to cut oil output as storage fills up. We've talked about this dynamic a number of times. It's about the movement of energy. If you can't move the energy, you have to store it somewhere. Now, Saudi Arabia has some options. They have an east-west pipeline. That can do some of the heavy lifting. That can act as a release valve. So the Saudis are essentially telling you, even with that, because the strait is closed, we're getting closer and closer to breaching storage capacity ahead of time. We're cutting output.
Yeah, and they also have the off-ramp of sending oil tankers through the Red Sea. They have done more of that. Even that hasn't been enough to offset this. So now it's the United Arab Emirates, Kuwait, as you mentioned earlier, following Iraq. Now we've got Saudi Arabia shutting down production as a result of storage facilities filling up. All of this just means a longer timeline for how long some of this production can really normalize, leading to questions of, do we have to change our timeline when it comes to market price?
And that headline, Bramo, that's a massive offset to whatever we might hear at 8:30 Eastern Time, when G7 ministers get together and talk about releasing reserves. That headline out of Saudi Arabia is far more important, I think, at this point, than anything they can say.
They can open the gates for their reserves, but it's not going to be enough to offset what we're seeing in terms of a lack of production. In the United States, the Strategic Petroleum Reserve only has 21 days of consumption, the lowest in decades. So how much is that really going to take us in terms of offsetting this?
It's a big headline this morning. Saudi Arabia has started to reduce crude output. This according to a person familiar with the matter. Up next on the programme, Sarah Hunn of Alpine, Saxon Words, Jeannette Lowe of Strategas, Kate Moore of Citi Wealth and Ellen Wald of the Atlantic Council. The second hour of Bloomberg Surveillance up next.
it's a labor market that is okay, but not strong.
You may start pricing back in some of the cuts that we just priced out.
If the Fed eases into an energy supply shock that is prolonged, the curve is going to steepen.
The higher energy prices will be a shock for American consumers.
The inflationary impact is months out.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your price action of scores look like this. Equity futures negative by 1% on the S&P, off the lows on the Nasdaq, down by 1.2 on the Russell, down by 2 percentage points. We're just off the highs in the commodity market. Crude, Brent overnight pushing 120. Right now, Brent crude 106 and up 14% on the session. This headline crossing just moments ago. Saudi Arabia starting to cut crude output.
This is coming after the UAE, as well as Kuwait, as well as Iraq, have all taken similar measures because their storage facilities have filled up. The reason why this is concerning to markets is that once you close an oil facility, it can take weeks or months, if it has fully been closed, to restart. Sometimes it can take a little bit less. Nonetheless, this prolongs how long it is going to take to normalize at a time when everyone's wondering just how big is the supply shock going to be and how long will it last.
8:30 Eastern Time, there's an attempt at an offset. G7 finance minister set to hold a call on releasing strategic energy reserves across the G7. The US reportedly supporting the idea. Is that enough to offset the pain that's been accumulating over the last week?
The market was up at $120 a barrel. It went down to about $103 a barrel when you saw this announcement. So evidently it moved the needle on the margin. It only moves the needle if you believe this is temporary. Right now, the oil market does seem to think that this will be temporary in terms of going back down to $80 a barrel by the end of this year. It's already higher, though, than where it was just a week ago. Nonetheless, at what point does this go on long enough for people to price in the pain economically, as well as in the forward curve for oil that isn't currently being reflected?
Brent crude, triple digits, around 105. Coming up this hour, Sarah Hunt of Alpine Saxon words with crude topping 100. Jeannette Lowe of Strategas as more countries scale back production. And Kate Moore of Citi Wealth as fears of a prolonged war rattle Wall Street. Our team coverage starts right now with Bloomberg's Jemana Basechi joining us out of Dubai. Jemana, an important headline crossing just moments ago. As we've discussed, Kuwait, Iraq, UAE, and now the big one.
This is the big one indeed. Yeah, Saudi Arabia saying that they started to cut oil output as storage has started to fill up. And you will recall over the course of our reporting of the past week, they had been looking for alternative routes to get this oil out that bypasses the Strait of Hormuz. And they do have that east-west pipeline that's available to them of reported capacity of around 5 million barrels a day. So it could have gone some way towards mopping up some of the production that needed to get out. But they've actually determined that it's not enough because their storage facilities have actually started to fill up. And just to give you the numbers here, Aramco produces around 10 million barrels a day. Around 7 million barrels a day are slated for export. The east-west pipeline can accommodate up to 5 million barrels a day. And the other thing that you need to think about is obviously we've flagged a lot the security concerns about the Strait of Hormuz, but there's an additional concern to think about on the Red Sea as well, in case the Houthis also get involved in this and start once again targeting ships and vessels passing through the Red Sea. So there may be a security consideration there to think of. But all in all, this is just another massive OPEC producer that has announced halted production or lower production levels because of these storage facilities filling up. And it is not about the damage that is sustained to these sites. From what we understand, limited damage has been sustained because of the ongoing attacks out of Iran. This is simply to do with storage being filled up and this oil having nowhere to go. So as long as we continue to be in an environment where the strait is effectively shut, you're going to hear more and more of these halts in productions, potentially full halts in productions. And as Lisa was just saying, it's easier to sort of trend lower with your production than to cut it off completely and fire it back up again because of then concerns around maintenance and bringing in extra operators to get pipelines up and running. And so for the foreseeable future, it just looks like they will be focused on producing less as opposed to fully halting production. But the longer the situation persists, the more obviously you're going to see an impact, a real physical impact on oil supply.
Jemana with the latest out of Dubai. Jemana, thank you. Jemana Basechi there. Crude right now around 105. Saudi Arabia cutting production, 1. Iran doubling down on hardline leadership, 2. And 3, the president reportedly considering a special ground operation to seize uranium in Iran as well. There is no sign of de-escalation there whatsoever.
And there's no sign of the ultimate goal for any of the particular parties involved, which is the reason why oil prices have steadily marched higher, and the reason why these headlines that came out over the weekend left people at 6 p.m. yesterday with a view that you have to send oil prices substantially higher, at least in the near term, before this resolves.
When Monday morning starts Sunday evening stateside, you know something bad is happening. Here's the view on Wall Street. Stocks falling, crude jumping above $100 a barrel for the first time since 22. Sarah Hunt of Alpine Saxon Woods writing the positives that investors were looking for are hard to hang one's hat on, given the oil price surge. Sarah joins us now for more. Sarah, good morning.
Good morning.
What changed with triple-digit crude for you?
I think it changes a lot of things. I think it's really, as we've all spoken about many times, it's going to depend on how long this lasts. The forward curve does not seem to think that this is a permanent state. And I think that what it changes is, one, the possibility of an economic slowdown or even going into a recession, because higher energy prices can often cause that kind of an economic shock. And what happens on the earnings front, both to margins and to spending and to everything else. Right now, this is a near-term problem. If it looks like it's going longer, it's going to change some of the math that everyone's been looking for the next couple of years in terms of earnings.
Consumer-facing names getting beaten up. Airlines, cruise lines, all getting absolutely hammered as crude continues to tick up. Are we at the point of demand destruction now?
I think it's a little early for demand destruction. I think that there's some obvious things that are going to happen as you see prices move very higher in the short term. But I think from a longer term perspective, it takes longer than a couple of weeks of higher prices. Do we get a couple of months of higher prices? That's definitely going to hurt it. And there on the margins, people are going to travel less. People are worried about traveling to begin with, just because there's something going on in a big part of the world that's really important. So I think you're definitely going to see some pullback in activity, and that is in and of itself slowing things down.
Sarah, have you been reluctant to sell stocks, any stocks, in response to this, given the fact that in the past, geopolitics is something that has always been a short-term event for markets?
I think this is, yes, I wouldn't say I'm afraid to sell anything, but it's more that, is this something that is really a permanent change, and what's your time horizon? If I needed, I tell people all the time, if you need money in the very short term, you should have it liquid. If you're in there for the long term, you're going to see a lot of volatility. We knew coming into this year it was going to be volatile. We didn't know why and how volatile it would be so quickly, but you expect after a couple of years, especially of such strong equity performance, that you'll see more volatility. The question is really going to be whether or not this sticks, or whether or not this is something that markets continue to see through and look through. And I think that there are other things going on in the background that are also potentially problematic. So it's going to be interesting to see how that plays out, and not interesting in a good way.
Yeah, we see, of course, what's going on with private credit. We see cracks in the U.S. economy. I'm just wondering, is there an inflection point, something that you're looking for that would change your view, that would make you materially shift your longer-term outlook for 2026?
I think if this continues to go on without figuring out what the off-ramps are. I think that it was a good move to say that globally the G7 will release some energy because prices spike so high. That's not going to solve the problem. The problem needs to be solved by having some resolution and having tankers be able to get through the Strait of Hormuz. Until we see some path for that, I think you're going to start to see people get more and more worried about those longer term both earnings estimates and just general economic conditions and the market. Right now, we're still in early days. If that really extends, I think that's really going to be the tipping point.
Some of that depends on what your starting point is, what your assessment of current conditions actually is. And we've got very different views on that. Some people think we're OK. In fact, the Federal Reserve, the top of the Federal Reserve, Chairman Powell, would insist that things are stable, they're OK. Others would say things are fragile. Where'd you come down on that, one or the other?
I think that they are a little bit more fragile than they look. I think that you've seen some disruptions in the labor market. You certainly hear a lot of rumblings in the labor market about what's going to happen because of AI in different sectors. There's a lot of spending that's coming out of that, though, so there are offsets to that. I think, generally speaking, absent this shock, the economy was doing fairly well. There were definite pockets of weakness, and you could see that in rotation in sectors in the market. You could see major rotation sectors. The headline indices are still fairly close to all-time highs, but there's been some major devastation in different sectors along the way. This is going to be one of those situations where, depending on how long it lasts, and this is, that's just going to keep saying that, we don't know yet what's going to happen, but on the margin, nothing good comes out of spiking oil prices this high and shutting in oil infrastructure.
Well, let's pick a sector, financials. Lisa talked about private credit. Blackstone, then BlackRock going into the weekend with a bit of trouble there. Then we've seen Morgan Stanley and Goldman Sachs start to underperform as well. This is going through the whole sector now and not just the private market players. What do you think that's signaling?
I think that's signaling some concern about weakness ahead and some concern about if you're going to have potential issues in both equity and bond markets, but you also have this private credit thing. This would be the top of the story if we weren't going on.
This would be the top story.
This would be the absolute top story, I think, if we weren't going through what we're going through right now with Iran, because this is one of those, it started out small and now you're seeing a couple of other things and then a couple of other things. And that's the kind of things that markets don't like. It's that uncertainty that markets don't like and investors don't like when everyone has been sort of trying to reassure everyone that it's all okay. And then you start to see things that make it look a little less okay. So I think that would be a much bigger headline if we weren't in the middle of this. And that would be something that would be starting to worry markets going forward.
Yeah, the idea that panic and sort of retail investors trying to pull their money and not getting it all back is very concerning to people. Can you put these two stories together of the oil price shock and credit concerns tied to private credit, the idea that some kind of increase in oil and decrease in consumer spending power could catalyze the fears that people see in credit sooner than maybe otherwise would take place?
Well, it's interesting because I think those fears were catalyzing on the back of expectations of problems in certain sectors, like the software sector specifically. But whether or not the reality on the ground is that they were as bad as it looked, I think the problem is more that everybody makes a decision in one direction. I don't know that the higher oil prices are going to make that worse because I don't think that the credits that people are worried about are ones that are so tied to the consumer. And I think that would be the link that I'm not sure we see yet. But it doesn't mean that it isn't there. And certainly people are going to start looking for that.
Sarah, it's always good to see you. Thanks for being here. Sarah Hunt there of Alpine, Saxon. Words on private credit, on energy, on the economic backdrop. We have had a payroll shocker. We've had an energy rupture. And we've got some real cracks developing in private markets too.
I mean, the fact that BlackRock followed Blackstone in terms of how they were going to meet redemptions, given the fact that people are concerned about some of these structural changes, would have been front page news. The fact that people are seeing these concerns continue to percolate, and yet here we are.
I don't think the energy move, though, takes it off the front page. I think it keeps it there. It exacerbates the problem. The tightening of financial conditions you're seeing now across Europe, in America as well, is not going to help matters. In fact, arguably, it's going to make it worse.
It might not be exactly the same story with software, but it's an even worse story if it's a broader economic issue. And the one thing that people have said is private credit will be okay fundamentally as long as there isn't a downturn in the economic cycle. What could catalyze a downturn in the economic cycle? Oil prices that reduce people's spending power to a certain degree, that they don't go out to Disney World, they don't fly to France. And this is exactly what people are talking about right now.
That's the bear case. That's the demand destruction off the back of moves like this. Brent, close to 105. Let's get you an update on stories worldwide with your Bloomberg brief. Here's our top story. Saudi Arabia has begun cutting oil production. The country's crude storage tanks piling up, with the Strait of Hormuz effectively closed to vessel traffic. The moves follow similar decisions from the UAE, Kuwait and Iraq. Elsewhere, President Trump isn't ruling out sending US ground troops into Iran. The administration saying it can achieve its goals in Iran without American boots on the ground, but refusing to take the option off the table. The president saying, quote, if we did that, they would be decimated. And finally, an IED was thrown outside of the New York City mayor's mansion in Manhattan. The violence erupting during an anti-Islam protest, the protest drawing an even larger crowd of counter-protesters who were accused of throwing the explosive device. The FBI launching a terrorism investigation after 6 people were arrested. And that is your Bloomberg brief. Up next on the program, pricing in energy panic.
We are suffering high prices, not in natural gas, but in oil, because it's a globally connected market. The oil is there. You're seeing a little bit of fear premium in the marketplace.
Up next, we'll catch up with Jeannette Lowe of Strategas, live from New York City this morning. Good morning. What a start to the week. Equities down again by 1% on the S&P 500. On the Nasdaq 100 down by 1.2. The airlines getting hammered, falling into a bear market. United, Delta trading softer by 3% in the pre-market after dropping double digits through last week. In the commodity market, this is what's driving things right now. WTI and Brent, triple digits. And if you think these numbers are bad, if you were tracking things overnight, Brent crude pushing 120 through 119 at session highs.
And this came after the disruptions to the UAE as well as Kuwait, after coming after Iraq in terms of turning off production or limiting it in response to storage facilities that were full. Also, the tit for tat that is increasingly targeting energy facilities. How much can some sort of strategic release of strategic reserves truly offset what we're seeing, which is just a complete breakdown in the supply chain?
When you start to see Saudi Arabia cutting output, and if you're just joining us, that headline crossing about 30 minutes ago, when you start to see those headlines, there's very little that you can do to offset that at 8:30 Eastern Time when finance ministers get together and talk about releasing reserves.
The only way that people can have confidence that that actually will stave off any kind of disruption is if you have an off-ramp, if you have a sense of when this can end and when production can start coming back. Right now, that just does not seem to be on the table. So maybe they can announce something at 8:30 that can get people a little more optimistic on that front.
Under surveillance this morning, pricing in energy panic.
We are suffering high prices, not in natural gas, but in oil, because it's a globally connected market. We're communicating with our allies abroad. The oil is there. You're seeing a little bit of fear premium in the marketplace, but the world is not short of oil today or natural gas. We are nowhere near normal traffic right now. And, that'll take some time. But again, worst case, that's a few weeks. That's not months.
So here's the latest this morning. Crude surging past $100 a barrel for the first time since the Russian invasion of Ukraine back in 22. The president calling the higher costs a very small price to pay as optimism for a quick resolution to the Middle East conflict quickly fades. Bloomberg's Tyler Kendall joins us now for more. Tyler, a lot of people have asked this question. I'll ask it once again. Why did we engage in this conflict without refilling the SPR ahead of time?
Yeah. Hey, John, good morning. That's actually a question that Democrats are now asking as they call on the Trump administration to tap the SPR. The thing is, we've heard from the energy secretary before that it would cost billions of dollars in both repairs and costs to fully replenish that stockpile. And instead, the administration maintains that there could be some other short-term solutions on the table that they would prefer to tap instead. That then leads to questions on whether or not we're going to actually see a resolution today when the G7 finance ministers meet. As you've been discussing on the program, this would only be the fifth time that this has happened, and no decision has been made quite yet. But people familiar with the matter do tell us here at Bloomberg News that some European nations are now concerned that the U.S. is going to push to pull back sanctions on Russian oil after we saw that waiver granted last week to allow India to buy those barrels. The thing is, as you well know, the White House is really under pressure when it comes to energy costs as they start to trickle down to retail gasoline prices and we head into the midterms. Now, John, the energy secretary does maintain this isn't going to be a long-term conflict, but no diplomatic off-ramp appears to be in sight. In fact, the White House is now threatening to widen the war. We heard from President Trump over the weekend saying the U.S. is now eyeing striking new targets. And Bloomberg News is reporting that the president is considering deploying special operation forces into Iran to extract the country's highly enriched uranium stockpiles.
And that's what escalation looks like. Bloomberg's Tyler Kendall. Thank you, Tyler, down in Washington, D.C. Jeannette Lowe, Strategas, writing the following. President Trump can pull out of Iran in 3 weeks and gas prices will go back to normal. The risk is if the conflict lasts longer. Jeannette joins us now for more. Jeannette, that statement begs the question if this is still in the president's hands, and if Iran wants to make this messy, they can make this messy for quite a while.
Absolutely. I mean, this could definitely be the risk here for the United States is obviously that this becomes a much more protracted war, or it also creates civil war and just chaos within Iran and then within the larger Middle East region. So there are definitely a lot of risks to the administration here. But I do think that the administration is really focused on this 4 to 5 week timeline. We do think that they have a plan to accelerate attacks on Iran to try to get to their specific goals, which is getting rid of the weapons that could be targeted at the United States and Israel, annihilating the Navy of Iran, and trying to then also prevent them from going after ships in the Strait of Hormuz, and also maybe potentially trying to get some sort of regime change or at least governance changes going forward. So I do think there's obviously some risks, but the administration probably is looking at this still being a 4 to 5 week timeline. We'll obviously see if that changes. And then what does this look like? They have said that there is a surge coming, that they will increase their attacks on Iran. So we'll kind of have to see over the next week to see, well, how does this play out? And then how does that change the timeline going forward?
Jeannette, are there any independent assessments of where the administration is on achieving main principles of that timeline, in particular, wiping out weapons that could attack U.S. and allies, as well as potentially regime change at a time where we now have a new supreme leader that President Trump has already said is unacceptable to him?
Yeah, I mean, I think obviously the regime change is going to be the biggest challenge for the United States and Israel. And I think you have seen the United States a little bit walk back that exact goal for this military operation. But you are kind of seeing the fact that they were focused on getting Iran's air defenses along the coast so that they could then strike deeper into Iranian territory. They do seem to have achieved that goal, at least particularly so far. But I think the big question is there's a lot of unknowns. We don't know if Iran has, more missile capacity that they are still kind of holding on to. That will be important. I think that the United States has been highlighting the fact that missile attacks and drone attacks coming from Iran have been down 70 or 80%, and they do think that they are losing firepower, but we don't also know what actually might still be there. So there's definitely still this risk, but I do think the administration sees that they have made some progress with getting out certain air defenses, using up some of the supplies that Iran has been using against the U.S. and its allies, and also that they're starting to be able to strike further and deeper into Iran. So that is a little bit of some progress towards these ultimate goals.
The U.S. is fighting this war alongside Israel. How aligned are these two nations in their ultimate goals?
Yeah, I mean, I think the one thing that was important about why potentially we may have gone into this is that there was an alignment between the two countries on the actual ability to go after Iran. And they both, I think, see this as an opportunity to really kind of strike at the weapons that Iran had that it was potentially using to threaten both of those countries, also trying to go after certain other pieces that Iran has been trying to do with its nuclear program. But obviously, we may see some disagreements longer term. We saw the disagreement over the weekend about the fact that Israel struck oil depots in Iran, and the U.S. was opposed to that. We also may see differences of opinion as to whether or not we're actually going to get regime change, or would the U.S. be more willing to accept some other outcome versus Israel. So I think there could be more fractures going forward, but we haven't seen a lot yet. But obviously, the longer this takes, that could obviously become something that becomes a bigger risk.
Jeannette, how much visibility do we have on what's happening inside Iran right now? This is a population of 90 million people, something like that, with very, very complex power structures, as anyone who's followed that country for a while will understand. Jeannette, those strikes from Israel are really, really important because that undermines the domestic support for what is happening. And that's been an argument of both Israel and the US for quite a while, to try and get the Iranian people on side to ultimately topple the leadership. There's little sign of that right now. How do those strikes help?
Yeah, I think that was one of the main concerns that the United States had, was that those attacks could actually make opposition less willing to go after the regime and less willing to kind of rise up in that way. And so that was why the administration was a little bit more upset with Israel for going after those attacks, because they do want to make sure that there are conditions where we're not actually helping to rally the Iranian people behind the leadership and feeling like they in particular are being attacked rather than the regime and the security forces that hold up that regime. So that is definitely a risk. Obviously, the other issue is that we do have these internet blackouts, which doesn't mean we always have a full understanding of what is actually happening within Iran. And that makes it a little bit more difficult to know what could be the ultimate outcome. Obviously, one of the big issues here is that we don't necessarily have a good understanding of, could there be an opposition leader who could actually rise up and take over in Iran, like what you saw in 1979, the fact that the Ayatollah was a particular figure. That, I think, is something that is going to be a risk going forward, and to see if that ultimate goal can be achieved.
Jeannette, thank you. Jeannette Lowe there of Strategas. Tehran is not Caracas, and the son of the supreme leader is not Dawson Rodriguez.
There isn't a sense of a continuation of power at a time when this is a fractured leadership in a very complicated society.
Up next, Kate Moore of Citi Wealth, as the war in Iran keeps markets on edge. This is the price of conflict in financial markets this morning. Check out energy. Brent, 105, briefly pushing 120, a move of almost 30% overnight. Right now, 13.4% higher on Brent crude. WTI up by 14% as well. That sets the tone for this. The equity market pulling stocks lower on the S&P 500 by around 1% throughout this morning, down 2 on the small caps. And in the bond market, pushing bonds down and yields up higher. 2s, 10s and 30s. 2s up by 4, 10s up by 3. And I keep going back to the international story. Pricing in tighter monetary policy in the UK, in Europe. The UK seeing a double-digit move on a 10-year and up by 20-plus basis points at the front end of the curve.
Starting to price in rate hikes, not rate cuts ahead. Deutsche Bank just put out a really good piece of research where they said historical risk-off moves after an oil shock, for example, S&P down 15%, generally require at least one of large and sustained oil price spikes. We're talking where we are now for a month or two. Hawkish policy response, speaking to the move that we're seeing in bonds, and then broader macro damage. That's sort of at what point do you see demand destruction start to kick in?
And that all depends on the first one. Whether this is sustained or not. The risk of a hawkish pivot is being priced. The reality of one yet to be seen. I don't think central bankers right now are going to rush out and make the pivot, but the longer it goes on, you start to see that in the data. That's when things start to get real.
And it matters where you start from. The fact that inflation in the United States already is closer to 3% than 2%, we're going to get some more data points this week, indicates how much inflationary momentum there already is in the system, which is only going to pressure a bigger move simply because we never killed the inflation beast entirely to begin with.
A 13% move in energy at the heart of everything in financial markets this morning. As we count you down to the opening bell, 2 hours away, let's get you some morning movers. Lizzie has more. Hey, Lizzie.
Hey, John, we have to start in energy. Oil, as you say, above $100 a barrel for the first time since 2022. Of course, that coming back to the Middle East conflict. And we've already seen gains for the European energy names, the likes of BP and Shell. That's set to continue in the US in the pre-market. ExxonMobil, Chevron, Occidental, all seeing gains. Flip over, and we're also seeing Hims and Hers up more than 50% earlier, pairing some of those gains now. But this on the news that it has resolved its feud with Novo Nordisk. Novo set to start selling its anti-obesity drugs on the Hims platform. And this reflects a similar deal that we saw about this time last year. You remember, and it fell through because Hims didn't stop marketing and selling its own copycat medication. So is this deal going to get over the line? Traders optimistic that it will. Just finally, Live Nation. We saw a redhead crossing the terminal on this stock earlier this morning, currently up 8.4% in the pre-market. But the redhead being that Live Nation is nearing a settlement with the Justice Department on the federal antitrust lawsuit. Now, this accuses Live Nation of illegally monopolizing the live music industry. It goes all the way back to the Obama administration, which, of course, allowed Live Nation to acquire Ticketmaster. But ever since that trial started on March the 2nd, we've had these settlement discussions hotting up. And now Live Nation up in the pre-market. Announcement expected in the coming days, John.
Lizzie, thank you. Thanks for the update. Some of the movers out there to watch into the opening bell. On our radar this morning, one of our top stories, G7 finance ministers set to discuss a joint release of crude reserves as prices surged to 4-year highs. The potential drawdown helping to pair some price gains after jumping to nearly $120 a barrel overnight. Elsewhere, President Donald Trump downplaying the spike in crude on social media, writing it's, quote, a very small price to pay for peace and safety. This is Iran's newly named supreme leader signals the Islamic Republic won't back down. And finally, the president considering a special forces mission to seize Iranian uranium. According to diplomatic officials, US and Israeli intelligence are searching for the stockpile. UN atomic inspectors last verifying its location nearly 9 months ago.
This is the enriched uranium that could potentially be transformed into weapons-grade material. And this is really the reason why there is concern by the likes of the International Atomic Agency. Unless you get people on the ground, you don't know how quickly or how close they are to actually forming some weaponry. This goes to the question of what is the ultimate goal? Is it to seize the uranium? Is it to get back to negotiating table with respect to making some deal? Or is that over? Is that not on the table anymore? And there only will be wholesale grabbing of this uranium in order to take the threat off
This
the table.
approach from the president, Bramo, I think is worth going over again and again. It's so different to the president's traditional playbook. To go into Caracas or to go and bomb the nuclear sites in Iran that we saw 12 months ago. Targeted, limited in nature. this feels so open-ended, and it feels like they're still mulling the options right now. That yes, there might have been a plan, but that plan's out of the window, and now we're talking about doing something different. And the escalation also, and I'm pleased you brought this up moments ago, the escalation over the weekend of Israel to go after Iranian energy infrastructure cannot be overstated. That is an escalation in this conflict, not a de-escalation.
And it's interesting that the United States was opposed to that move. Israel bombing Tehran's oil supplies. It does kind of question how you're going to win over the hearts and minds of people living there, given the fact that they're experiencing oil rain. There also is an issue of, well, all of a sudden you've made this fair game. The U.S. also damaging certain desalination plants, or reports of that in Iran. This also amping up the game in terms of what's fair game to go after. So a lot of questions about the off-ramp as well as the goals. You're right. The goalposts seem to be moving in real time, which is the reason why no one has a sense of what this plan is and when we can say mission accomplished. We know that's a terrible term in terms of historical precedent. Nonetheless, we're just looking for a sense of when you can actually calm things down.
If you were just tuning in, welcome to the programme. And let's say you heard all of that and you guessed where equities were right now. I don't think you would have guessed the S&P was only down 1%, but that's where the S&P is this morning. The Nasdaq down by about 1% as well. We're down by 1.7 on small caps. The Russell 2000 underperforming. Let's keep it there on the equity market as Iran's chokehold on the Strait of Hormuz is disrupting the flow of energy, sending prices soaring above $100 a barrel, and Saudi Arabia, the latest to cut output, that headline crossing in the last hour. Kate Moore of Citi Wealth writing this: we expect markets to remain volatile until we get clarity around both the measure of success for the US and Israel and the subsequent off-ramp. Joining us now, Kate Moore. Kate, welcome to the programme. Stocks are down 1%. Can I call that resilient? Is it fair to say that that's pretty resilient given the risks we're talking about?
Well, I mean, I think, John, what we're seeing is the resilience in the U.S. large cap space. And that's largely because we have to understand where positioning and sentiment was before this strike. And that was that U.S. large caps were less attractive or less exciting asset class or, part of the equity market than others. You saw the biggest move so far in the small cap space, in non-U.S. equities, places where there was a significant move over the course of 2025, much of it driven by multiple expansion and not earnings. And the U.S. large cap space, the S&P 500, which has been treading water for 6 months, is holding up relatively well because people had already taken down a little bit of their exposure there. And it's frankly a higher quality part of the market. So there were a lot of things in terms of positioning and sentiment in play at this moment that I think are leading the U.S. large caps to outperform in the equity market. And frankly, our view is that is likely to continue, that U.S. large caps are the safest place in that risk asset.
Within those large caps, what's the sector preference with that in mind?
Yeah. So here's the thing. We need to separate out kind of what's cyclical, what's going to be prone to the shock, and what might be secular. In this case, a lot of people had faded their risk in the tech and comm space, and we understand why. Huge concentrated positions. We've talked about it so many times. Questions around the sustainability of AI CapEx. Hopefully people took some of that fear off as we went through first quarter earnings season. But, the whole point is that people were taking down some of the risk in some of the secular growers. I think those still offer better quality and, frankly, better likelihood of being able to sustain their earnings momentum, even in more kind of a geopolitical and economic shock environment. But I do want to mention something on the cyclical side, because we know there is consistent demand for industrial metals. We've talked, of course, about copper and other things going into the AI build out and CapEx story. I think we'll see, even if there's a significant amount of price volatility across the resources complex, that the opportunities there remain quite strong in the material side.
Kate, have you changed anything about your recommendations to clients on the heels of the conflict in Iran? Have you suggested to them that they shift anything other than just hold pat, stay with what's working?
Yeah, no, Lisa, I haven't at this point. We're just obviously one trading week into it, and we've been watching price action. We feel like we're in pretty good shape in terms of the way our portfolios are constructed, particularly because we have a focus on resilience and we have a focus on high quality. Now, I'll be honest, the first part of this year, there were times where I felt a little uncomfortable because we didn't want to own the small caps for the same reasons that other people were. We didn't see the same kind of quality trade there. And we continue to believe that, the U.S. should be a significant anchor of your equity exposure. And this was, a little painful when other markets were outperforming. But right now, building for resilience, building for quality really is doing very well for us and our clients. The one thing, Lisa, I just want to point out, though, is that we keep on looking for areas of dislocation. Are there massive drawdowns in some of the things that we like over the medium term? And, can we use some of the cash and some of our, tactical skills to really take advantage of these drawdowns? The trouble is, because we have no sense for how long this conflict is going to last, how it might broaden, and what the reaction function might be from countries, not just in the Middle East, but around the rest of the world, it feels like we should kind of sit on the sidelines for a moment here, observing price action before we take moves.
There's also a sense that if the Fed or the ECB or the Bank of England starts to hike rates in response to the inflationary shock, that will also start to change the equation, given the backdrop of growth that isn't in recession, but isn't exactly going gangbusters. And there's a feeling that financial conditions have already been tightening. What kind of risk does that pose, given that most people's base case was 1 or 2 rate cuts this year from the Federal Reserve?
Yeah, that's right. And Lisa, you might remember, actually, we've been out of consensus a little bit in talking about how sticky inflation has been. Honestly, I thought people were going to throw tomatoes at my head in the fall when I was first talking about this, with our clients and basically saying, hey, look, we're seeing many components of both CPI and PPI and PCE moving at a rate year over year that is uncomfortable and is likely to keep overall inflation levels elevated. And I joked for some time, hey, if I was a FOMC voter, it's not clear to me, frankly, that I would vote for rate cuts over the course of the fall. Now we're in a situation where we already had that, price pressure from goods. Obviously, we'll be watching CPI very closely this week, and services inflation had stayed sticky, and now we're going to have this shock. I think it's very fair for the market to be asking these questions. What is the next policy move from all these central banks, and will there have to be a reaction? But we know these interest rate moves are blunt tools, right? And I'm not sure that raising rates alone is going to really change the supply picture that we have from oil that's leading to higher prices. So I'm not banking on a whole bunch of hikes at this point, but I do think it's fair for people to take cuts off the table.
That's the difference, and it's still key. Kate, thank you. Kate Moore there of Citi Wealth. What will central banks do? I don't know. But people were comfortable with the idea that cut interest rates a few months ago.
And right now, that comfort is gone. Not only that, but you're also looking at the potential for rate hikes being priced into the ECB. I keep going back to this Deutsche Bank note because it's talking about how hawkish policy response is one way you get that huge drawdown in risk assets, because ultimately that has a material effect on projected growth ahead, and that is not something particularly the euro area can afford.
In anticipation of that, financial conditions are tightening right now. Don't need to wait for the hikes. It's happening right now. You can see it in the yield curve across Europe, in the UK, in Germany and elsewhere.
And that's the reason why it's really going to be a conundrum, because it's going to already have a self-fulfilling prophecy on the expectation of this. They're also tightening from credit perspectives as well because of some of the concerns about private credit. So it's kind of a double whammy there.
Peter Shea of Academy with this to say this morning: the downstream problems are real, especially in Asia. Gasoline, diesel, jet fuel, all the chemicals. Lots of people are discussing exactly that. And he goes on to say, as facilities get taken offline, the restart to fully operational is weeks, not days. And finishes on this: things like a global SPR release might help. They're not a solution. And we've all got to have that in mind. At 8:30 Eastern time, of course, about 47 minutes from now, when these finance ministers get on the phone and discuss the potential of releasing reserves.
It all comes down to when you get an off-ramp to stop the conflict and to get ships going through the Strait of Hormuz once more. It's not going to be putting a Band-Aid on it that's going to really get people that much more comfortable.
Crude this morning higher by 12 to 13%, around 105 on Brent. Let's get you an update on stories worldwide. Here is your Bloomberg brief. The US ordering non-essential American diplomats in Saudi Arabia to leave the country. The move marks Washington's first ordered departure since the war with Iran began. It follows the death of a US service member who was wounded in an attack on US troops in Saudi Arabia on March 1st. Elsewhere, Australia's government is assessing a request from Gulf nations for defensive military support against attacks from Iran. The Foreign Minister, Penny Wong, declining to say exactly what Australia might provide and pledging transparency if a decision is made. And finally, the New York Times reporting federal authorities searched 2 homes in Pennsylvania after a homemade bomb was thrown outside the New York City mayor's mansion over the weekend. 2 suspects are in custody after the device was thrown by counter-protests to an anti-Islam demonstration. City officials are expected to update the investigation at 9 a.m. Eastern later this morning. And that is your Bloomberg brief. Up next on the programme, mitigating an energy crisis.
So you don't think Navy escorts of vessels are necessary?
There could be, their early tankers probably will involve some direct protection by the U.S. military. But most important is to defang their ability to threaten these ships.
We'll get into the commodity market next with Wald of the Atlantic Council, live from New York City this morning. Good morning. You're watching Bloomberg Surveillance. So this is how the pieces of the puzzle are coming together so far this morning. If you can't get the energy out of the Strait of Hormuz and you're starting to bump up against storage capacity, you cut production. We've seen that from Iraq to Kuwait to UAE and now this morning to Saudi Arabia. G7 finance ministers getting on the phone in about 42 minutes from now to discuss an emergency release of energy reserves. With that in mind, crude higher by double digits. Brent 104, WTI 102. In the equity market, stocks softer, lower. We're down across the board on the S&P, negative 1.1%. I mentioned the airlines. They're in a bear market. The cruise lines, hammered, down 20% since this war started. Norwegian, Carnival, down across the board.
A lot of the transportation sector did not hedge against oil as time went on because those hedges proved costly. So there is a rush to hedge against this. It's a 1-2 whammy. On one hand, people don't want to travel. On the other hand, oil prices skyrocketing, increasing input costs. It is not a good recipe.
See it in stocks, you see it in bonds. Check it out. Bonds down, yields up across the curve. Tame moves, mild moves, muted stuff stateside relative to what you'll see abroad. We're up 3-4 basis points at the front end of the US curve. The front end of the UK curve, yields are higher by 24 basis point. Never mind 10s, check out 2s, and that is about monetary policy. And monetary policy is on the back foot.
Right now, the UK and the Euro, the continental Europe, really are facing a much more severe energy shock and single mandate central banks that are going to have to respond to inflation. Raises a question, how do you deal with both the demand destruction coming from the oil shock with the idea that fiscal appetites are going to have to go towards supporting people's bills at the same time that you have central banks tightening financial conditions? Again, this is not a recipe that bodes well for risk assets, which is the reason why you've seen European stocks have a full correction since their February highs.
Let's talk about energy. Under surveillance this morning, mitigating an energy crisis.
I think in the relatively near term, you're going to see their capacity so low that we'll see more normal ship traffic return to the Strait of Hormuz.
So you don't think Navy escorts of vessels are necessary?
Yes, there could be. Their early tankers probably will involve some direct protection by the U.S. military. But most important is to defang their ability to threaten these ships.
So here's the latest this morning. Oil prices surging past $100 a barrel. The effective closure of the Strait of Hormuz forcing Gulf producers to reduce output. Wald of the Atlantic Council writing, it is within the U.S.'s power to mitigate the emerging energy crisis. There is still time to prevent it, but the clock is ticking. Ellen joins us now for more. Ellen, this feels like a crisis already. What would you call it?
Yeah, we're absolutely in a full-blown energy crisis. I think that the initial stages of it, if tankers are supposed to wait until they've neutralized every Iranian drone, we're going to be here for a long time. I think they need to take some steps to get tankers moving, even if they haven't completed the military missions and destroyed all of the ballistic missiles and all of the drones. And there are steps they can take to help get this going, including military escorts, but also reroute the shipping lanes towards the UAE and towards Oman and away from Iranian waters. That would make it more difficult for them to actually get the drones there. It would make it easier to detect them. I mean, these are some fairly simple things that they could do, to help make shipping less dangerous.
And at 8:30 Eastern time, there's going to be a call with G7 finance ministers. They're discussing releasing reserves. What difference is that going to make?
I think it will help with oil prices, but understand, countries that are members of the IEA, they are required to have about 90 days worth of oil imports stored. Some countries have more. Japan, for example, has, 250 days worth of oil stored, but this is going to deplete their reserves. And it's not necessarily going to help countries that don't have reserves. I mean, think about non-G7 countries. Think about Pakistan, for example, and other more emerging markets. They don't have these reserves. India, for example. So while releasing the reserves may help take some of the pressure off of what European countries and some more advanced Asian economies are facing, it's not going to necessarily help these other countries if they can't get oil out of the Gulf either.
Ellen, you've studied the Saudi leadership for a long time. You're intimately connected with the family and the different political shifts. Do you have any insight into how on board Saudi Arabia is, as well as the other Middle Eastern nations, with this effort by the United States? Is the U.S. still considered an ally in this particular effort?
Well, I think that the U.S. considers Saudi Arabia a strategic partner in general. Saudi Arabia absolutely thinks of the U.S. as probably more than a strategic partner, though they can be a little bit upset when the U.S. Doesn't necessarily see them as close an ally. I do think that Saudi Arabia and the UAE and all of these countries that have been physically bombarded by Iran are pretty much united, in this effort. But I do think that their patience, as this military effort kind of dredges on without movement of tankers in the Gulf, their patience is going to wear thin, and they are going to maybe put some pressure on the U.S. to either wrap things up or help them get things moving. There are things the U.S. can do, and it seems that they're not jumping on it. They don't see it as immediate concern as these other Gulf countries do. Remember, oil and gas, that's their livelihood for the most part.
Ellen, I just want to break in. You said that there are things that they could do. Like what?
Well, I do think that military escorts are the first. They can also work to reroute the shipping lanes. Like I said, the current shipping lanes take tankers into Iranian waters about 10 miles away from the shoreline. That makes it incredibly easy for Iran to send drones at ships. That's not the only place ships can go in the Strait of Hormuz. It's 30 miles wide. They don't have to be right up next to Iran. And through a coordinated effort, they can move those shipping lanes closer to the UAE, closer to Oman, and help ships have some buffer between Iran and where they're going. And that could happen. That's entirely feasible. It just seems like no one's making the effort to get it done.
Ellen, this is a tense time. Can we finish on a lighthearted question? Are you on a cruise or a luxurious tanker?
I'm not.
Where
I'm
are
not
you?
on a cruise. No. I'm actually in a hotel in Fort Lauderdale.
Okay, there we go.
Looking at the ocean.
Just seeing the ocean in the background, trying to figure it out. Just seeing how seriously you were taking today's interview. Ellen, thank you. Ellen Wald at the Atlantic Council. Ellen would fly in on a chopper to a tanker, right? Do it live.
Completely. I'm doing some on-the-ground research, and right now things are tense. Things are stable in this particular region, but over there, a tanker is... look, that was an incredible backdrop. Should we all be so lucky?
Yeah, I know. Things are very tense this morning, up by 12% so far on Brent, 104. WTI around 102. Coming up next, we'll catch up with Savita Subramanian of Bank of America. We'll speak to the former Kansas City Fed President Esther George, Sarah House of Wells Fargo, Alicia Levine of BNY Wealth. With futures right now, negative 1% on the S&P 500 and bonds. Worldwide selling off. Bonds down, yields higher. This 2-year in the UK higher by 24 basis points. Live from New York City, the third hour of Bloomberg Surveillance up next.
The market has been driven by what's happening globally.
We could break out to the low side on equities.
Broader risks to energy supply have to be monitored and likely priced.
Despite this jump that we've seen in oil, we are going to have that backdrop continuing around earnings growth. The underlying fundamentals are still pretty positive, and people want to own this equity market.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now. In the price action, your scores look like this. Well off session lows. We were down by something like 2% on the S&P overnight. Now down just 1. On the Russell, down by 1.9. In the commodity market, these moves right here, pushing 120 overnight on Brent. Brent back to about 104, still higher by 12% after gapping higher big time through last week. The main event now for us in the next hour, 8:30 Eastern Time. There is a call with G7 finance ministers discussing releasing emergency energy reserves to do something to offset a major rally in energy prices.
This has been done about 5 times before, including twice after the 2022 invasion of Ukraine by Russia. A question of how much this will actually do when it comes to lowering oil prices, given that ultimately this is a supply shock. And some people are saying the worst supply shock and supply chain disruption that we've seen in the oil industry going back in modern history. I mean, there really is a question of, can you really offset this just simply by opening a small tap?
Think about the last few days. The escalation is increasing, not decreasing. And what you're seeing in commodities right now, the output is being cut. It's not bouncing back. And you can look at the headlines of the last 1 hour or so. Saudi Arabia cutting output. This headline just moments ago. NATO intercepting ballistic missile that entered Turkish airspace. That does not sound like any kind of de-escalation to me this Monday morning.
It's dragging more participants in, right? The fact that NATO, this is, I believe, at least the second intercepted ballistic missile targeting Turkey. A question of how far this can go and what the off-ramps are. Some questions to be answered. Are some of these oil-producing nations turning off the taps, or are they just limiting production? There is a difference in terms of weeks versus days to turn it back on. Also, can you do more to try to get the shipments through other channels, like Ellen Wald was just saying? A question here, I was looking at our Top Live blog, and top news, one Saudi Arabian tanker made it through the Strait of Hormuz. The fact that that was news gives you a sense of where we are.
I will take it at this point, right? Given what things have been developing and which direction they've been going in over the last week or so, we'll take that at this point. Look at the European equity story. Real underperformance. We've got the Euro Stoxx 50 down by 1.8%. You've got the underperformance in Europe and the European bond market as well. I've talked about this repeatedly throughout this morning. We're pricing in tighter monetary policy. UK yields higher by 20 basis points at the front end of the curve. Twos right now, surging, and you see that across the curve in Europe.
There is a profound inflationary shock, and people are expecting monetary policymakers to potentially have to respond to that with even 2 rate hikes this year from the ECB. The Federal Reserve still pricing in no hikes, but definitely pricing out some of the cuts that had previously been priced in. At what point does that add insult to injury at a time when there already is demand destruction coming from oil prices?
Stocks on the S&P this morning down 1%. The opening bell about 87 minutes away. Coming up this hour, we'll catch up with Savita Subramanian of Bank of America as the equity market sell-off deepens. We'll speak to the former Kansas City Fed President Esther with the central bank facing growing inflation fears, and Alicia Levine of BNY Wealth with oil prices surging to 4-year highs. We begin this hour with stocks sinking as the spike in crude is rattling global markets. Savita Subramanian of Bank of America writing geopolitical shocks usually mean buy the dip, but with what? Cash is depleted. Key risks to the S&P index are less sideline cash and higher allocations. Savita joins us now for more. Savita, good morning.
Good morning.
Are you saying things are pretty fragile right now?
They feel like it. I mean, I don't know if we're setting ourselves up for a really deep bear market, but I do think that this doesn't feel like the beginning of a great year. And in fact, it kind of rhymes with 2022. Remember the beginning of 2022? Everybody was really pulled up. It was going to be a fantastic year for equities. And then we had war breakout, and here we go again. So I think it's just another, it's another wrinkle in the liquidity story. I mean, we've got this year where we're still penciling in Fed rate cuts, and this is in the backdrop of massive inflation reappearing. So I think that right now doesn't feel like the setup that we were expecting at the beginning of the year.
You're not super bullish at the index level, but has the sector preference shifted given the shock in energy over the last week?
I think so. We're overweight energy, which I think that's likely to continue to work. But we have to be nimble there. And then financials is one sector where I worry about just the credit cycle hitting those stocks and potentially just private lending, being more contagious than we're expecting. But, we're overweight consumer staples, and that's one sector I worry about a little bit. One of the reasons we upgraded was we thought that the administration was going to be focused on affordability and quelling inflation, and that seems to be the opposite of what's actually happening. So I think that that's one sector we need to really watch carefully, because typically is hurt more by inflation. We're underweight consumer discretionary. I'm happy with that call. I think the consumer is not going to do as well this year in terms of spending on wants over needs. So I think that, you know, we're at a point where you want to play the stagflation playbook. Little known fact, one of the best performing indices during the 70s stagflation was large cap value, which I've liked for a really long time, and I think it's almost more reason to
Hold on a second. Why do you think this is analogous to more of a 1970s style stagflationary shock?
Well, okay, look, I mean, maybe it's not perfectly, you know, everything rhymes. So I think part of what we're seeing now is an environment where the consumer might be struggling a little bit. We're going back to more of a manufacturing economy rather than just tech and asset-light companies. And we have some inflation surprises. I don't think we're going to see, you know, Volcker-like inflation, but I do think that we are in an environment where the surprise is that inflation is moving in the opposite direction. Rates are moving in the opposite direction than folks were expecting this year.
You also said that cash is depleted.
Yeah.
Can you explain, given the fact that people would look at the money market funds and say, well, there still is almost $8 trillion there.
That's true.
What do you mean when you say that?
So, you know, you're right. The money market, there's still $6.5 trillion and close to $7 trillion. But I think that money hasn't really moved, despite the fact that the Fed has been cutting interest rates. So I don't know what gets that money to flow back into the market. Where we do see depleted cash levels is in mutual funds. If you look at mutual fund cash balances, institutional investors are now at the lowest levels we've seen in the history of our data. And I think it's because they were forced into the market because of all this, you know, great stuff happening in 2025. And on top of that, they have big outflows last year. So they, you know, they don't have that cash cushion to add exposure on the dips. And that's what I worry about is, you know, geopolitics by the dip. We've all heard it. We write about it every time this happens. But I don't see a lot of liquidity on the sidelines today. Even individual investors are, you know, increasingly more bullish than our advisors and our surveys. So I think that it's a really unusual time in terms of just kind of catching up to this bull market. 2 years ago, everyone was expecting a recession. Today, boom. That's the consensus call, boom economy. So, you know, I wonder about expectations versus reality this year.
You've written about this. I want to ask you this question. How have private-public market strategies evolved in the last few years? And as private market money increasingly looks a little bit locked up and tense and fractured, pick your word, what does it mean for the strategy to public equities?
Yeah, well, I think that that's one kind of technical risk to the S&P index is the fact that this is the most crowded ticker in the world. And if you look at asset owners, they've basically legged into owning private equity and S&P index funds. They no longer own stock pickers or fundamental investment portfolios. They're either in the index or in private equity. And if anything happens that problematizes your returns or your ability to sell your private portion of your portfolio, you're going to be a forced seller of the S&P index. And if everyone's a forced seller of the S&P index at the same time, how liquid is it, right? These are the liquidity scares we've seen in the past. And I mean, I don't see this as a 2008 style liquidity crunch, but I do think there are pockets of real crowding that could get shaken up.
Are you seeing signs of that emerging right now, or is that just a risk on the horizon?
I mean, we're seeing it happen maybe slowly, quickly on certain days, but I think you're seeing it with tech, with, you know, mega cap tech, long duration, you know, the really crowded growth stocks in the S&P 500 have sold off pretty demonstrably, even though their earnings have been okay. So, you know, it's kind of what the setup was. Super high expectations. These stocks are still delivering, but they're not necessarily crushing expectations as much as we saw. So I think that positioning is getting shaken out a bit. But when you look at other areas, like just the S&P overall, I think the biggest risk is we haven't seen a down market with like a protracted down market. We've seen a couple of fast bear markets, but there's been no question for investors that buying the index isn't a good idea, right? It's always been a good idea. Every year you've wanted to buy the index. what happens when the index doesn't do as well? I think that could breed outflows. You know, it's a new theme that investors aren't necessarily expecting.
Can I just finish by gauging sentiment through your conversations with clients?
Yeah.
How much pushback do you get to this pitch, and has that changed as the weeks have progressed?
I mean, I think that now we're getting more buy-in, but you know, at the beginning of the year, I think there was a lot of bullishness on tech. There was a lot of, you know, why bother buying anything else if tech is the growth story still? So I wonder if that buy the dip mentality will manifest itself in tech. That's where I see the biggest appetite to add exposure, and it's kind of like post-2000, right? After March of 2000, you saw these little rallies in tech because folks were like, oh, you got to buy it on the dip. And then it took maybe a couple of years for investors to give up.
Savita, always good to see you.
Great to see you.
Thanks for being here. Thank you. Savita Subramanian there of Bank of America. Speaking of tech, I don't think we've mentioned it. I think software was up every day last week. IGV, the must-track software ETF at the moment.
Yeah, people seeing at least something that they thought might be undervalued and was sort of independent from the oil shock. The conversation you guys were having about the structure between private equity being lock up and sell what you can. We're seeing that in gold, too, right? The fact that gold prices are down, it's sell what you can. And it gives you a sense that there is some sort of liquidity mismatch right now going on that speaks to potentially a broader structural readjustment.
One more dimension as well. Maybe you can explore this tomorrow, but sovereign wealth funds, particularly those in the Middle East, I wonder how much pressure is going to be on them in the coming months if this continues. If you can't sell the energy, if you breach in storage and you have to cut production, what are you going to monetize?
Yeah, are you going to have a force majeure and say, maybe I'm not going to pay for that project in Tennessee? And that's something that the Financial Times has been reporting on, that potentially a number of countries in the region might pull back from some of those commitments.
Stocks this morning down by about 1% on the S&P 500. The opening bell about 1 hour and 17 minutes away. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg brief. Iran naming the son of the assassinated Ayatollah Ali Khamenei as its new supreme leader. State media reporting the 56-year-old winning a decisive vote from Iran's Assembly of Experts. The choice was quickly criticised by the president, Donald Trump. Elsewhere, the US ordering non-essential American diplomats in Saudi Arabia to leave the country. The move marks Washington's first ordered departure since the war with Iran began. It follows the death of a US service member who was wounded in an attack on US troops in Saudi Arabia on March 1st. And finally, the New York Times reporting federal authorities searching homes in Pennsylvania after a homemade bomb was thrown outside of the New York City mayor's mansion. The incident occurring at an anti-Islam protest. Counter-protesters were accused of throwing the device, which failed to detonate. City officials expected to give an update on the investigation at 9 a.m. Eastern Time. And that right there is your Bloomberg brief. Up next, the morning calls, plus the former Kansas City Fed President Esther George, as the central bank is facing growing inflation fears. That conversation just around the corner, live from New York City this morning. Good morning.
I think we're still at peak uncertainty on tariffs. So in that sort of context, now you throw in the dynamics with higher oil prices, that really changes the outlook for headline inflation. So the Fed is going to be very, very focused on what happens on the inflation side while paying attention to the labor market, but I think inflation is going to take priority.
That was Subadra Rajappa of Société, following a sell-off in the global bond market following a major move in crude. As we count you down to the opening bell, equities declining, but off the lows, well off session lows, down by 0.9% on the S&P. On the Nasdaq, down by 0.9. The underperformance on the Russell down by 1.5. Much of the research I've read this morning as expected. This a little different from Mike Wilson of Morgan Stanley. We think we're closer to the end of this rolling correction than the beginning. We remain constructive over the next 6 to 12 months. The pace of increases in crude and the dollar will determine how long volatility persists, but US equities are in a favourable position. versus their international counterparts.
Yeah, Ms. Levmasteka over at JPMorgan reiterating that and having a similar view this morning, saying that right now there are areas that look oversold and people should maybe start buying. A question of whether this is a U.S. phenomenon or more broadly, if this is something that people can engage with the expectation that this will be short-lived. Again, we keep going back to the timeline and how crucial that is.
What did we talk about last week? And it wasn't a judgment about one group being wrong and one group being right. Just the difference between how the equity players were talking about this moment and the commodity experts. The equity players were waiting for that buy the dip moment, conditioned by the experience that when things get tough, the president backs away. The commodity players were looking at real stress and downstream effects of what's happening through the Strait of Hormuz, what will happen to production and what's developing in Asia with the refiners over there under intense pressure at the moment. And at the moment, if you were going to pick on one group that's been right and another group that's been wrong, at the moment, the energy experts have absolutely nailed the risk here, and the risk is materializing.
Yeah, and now it's just a matter of how long this goes on. And you mentioned Jordan Rochester from earlier this morning. And just to repeat what he said, this may be a war, but it's also perhaps the biggest energy supply logistics crisis we've ever seen in modern history. If that is prolonged, then it will start to affect risk sentiment. And that's what people are waiting to see.
Futures just off session highs were negative by 0.9% on the S&P. That's the price action here in your morning calls. First up, TD Cowen cutting its price target on United Airlines and other major carriers, noting it's hard to envision margin expansion this year without a rapid decline in energy prices. That name down another 2.5%. Your second call from Barclays lowering its price target on Oracle to 230, expecting margin pressure from upfront costs in the AI build-out. And finally, RBC Capital downgrading Dow to outperform, believing market tightness could lead to a margin uplift. The latest on Dow there, I should say, was an upgrade to the stock from RBC Capital. Dow in the pre-market higher by 0.2%. Let's turn back to our top story. Surging oil prices sending bond yields higher across the globe. Investors raising bets central banks will keep rates on hold. The former Kansas City Fed President Esther George writing, with oil prices surging over $100 a barrel, inflation is sure to move higher. The Fed will want to look through this price pressure, but it will likely stay their hand for entering rate cuts or entertaining rate cuts. The former Fed president joins us now for more. Esther, welcome to the programme. Let's just get to that statement and your experience too. I always want to lean on that. You lived the 22 energy shock. Can you frame for our audience the similarities, the differences between this moment and that one?
Well, good morning, Jonathan. Yeah, I think the uncertainty that we've talked about for some time is one of the characteristics here that we have to remember. We have been relying heavily on a consumer that has faced significant price shock coming out of the pandemic. This is a consumer that has felt the impact of the tariffs, and they also have felt the uncertainty associated with a job market that has shifted significantly. And so when we rely on the consumer, as we do here in the U.S., that becomes a real focal point, I think, for trying to understand. Now we have added a new shock, this gasoline price at the pump. We understand that diesel prices will be affected, which of course will feed into the cost of transportation and other things. And I think it creates a real point, not just of uncertainty, but I think heightened risk around consumer spending and growth as we look ahead.
When you were at the Federal Reserve through the 22 shock, household balance sheets were arguably much stronger and the labour market was much tighter. Do you think differently about how this price shock in the energy market will work its way through the economy?
Yeah, I think you hear a lot about the K-shaped economy, and I think that will come into the fore now. We have really been relying on a group of consumers that can power through this. But you can only stress weaker household balance sheets that have, again, had the benefit of having jobs. That has been really, I think, one of the tailwinds here. But there is a breaking point, I think. And so I think the Fed will have to be particularly focused on thinking about how that consumer is going to be positioned today to be able to look through this kind of additional price pressure.
Esther, that could go one or two ways. On one hand, you could make an argument for easing policy to try to give lower income consumers a better scenario, a better backdrop to meet this price shock. On the other hand, you could say the Fed has a role to play to combat inflation. Which side of the equation do you fit on?
Well, the Fed has been focusing on the labor market and on weakness at, I think, the risk of inflation even before this oil price shock. Now I think the Fed, and you hear them increasingly talking about the risk of inflation, they have allowed it to extend out for a period of time that now puts them in a very, very difficult position, I think, in understanding how they're going to weigh their policy risk. Whether they continue to think they are as well balanced coming into this March meeting, I think is going to be something to listen for here, because you are going to have headline inflation for sure. We'll be getting more numbers in this week to see that. And I think the calculus around keeping those inflation expectations in the long run anchored is going to be a point worth talking about.
Rates traders are pricing in rate hikes over at the ECB as well as the Bank of England. Do you think that as this progresses, if it does continue for a longer period of time, that that's going to be a scenario that's reflected in how the Federal Reserve is being priced?
Well, I think obviously a little bit different for the U.S. to think about that and the Fed as it contemplates its updated dot plots. But I do think it stays their hand on being able to suggest that they are looking to rate cuts, but maybe in a pause mode. I think this kind of environment will really remind them that inflation target has to be credible, and they have to keep focused on that, even if their tools right now are in conflict. They are looking at a job market that may be stable, but has shown signs of weakness, while they have been looking at inflation that continues not only to be persistent, but as we've been talking about, is now going to show some upward pressure.
Esther, would you describe this labour market as stable?
You know, I consider it stable in the sense when you step back and look at the unemployment rate, which is our best gauge, I think, of how that labor market looks. It does mask what is underneath that surface of a lot of moving parts. I think we're beginning to see the real impact of some of the immigration policy hits here. We're beginning to see the uncertainty, I would argue, play out, where businesses are happy to hire for positions they feel confident about, but they're not going to move hard and fast relative to the growth levels that we've seen. So I think it's a tentative labor market, in my view, even though we continue to enjoy a relatively low unemployment rate.
Esther, George, always appreciate your time. Thanks for jumping on for us. The former Kansas City Fed president, an individual who lived the energy shock of 22 at the Federal Reserve, talking about this Federal Reserve and a meeting that takes place on the 18th. That's a week away next Wednesday. That feels like a lifetime away. And if this conflict is still ongoing, with no sign of an off-ramp or de-escalation, all bets are off for the next 9 months.
This is a reason why CPI and PCE, core PCE, two metrics that are coming out later this week on Wednesday, and then after that, Friday, is going to be really important to set the tone. If those are hot readings, does that leave the Fed in an even worse position given the oil price shock that we're seeing unfold?
So we've got a 30 minutes that you're going to want to track. Sarah House of Wells Fargo is going to join us in just a moment, looking ahead to the inflation data that Lisa's talking about. Plus, Danny will have your morning move as defence names rising in the pre-market. Lockheed Martin is up 40% so far year to date. We'll get into that in just a moment. Plus, we'll track a G7 finance minister's call on releasing energy reserves. That's next. This is Bloomberg. It has been a bruising session worldwide. Equity futures stateside negative 0.8% on the S&P 500. On the Nasdaq down by 0.9. On the Russell down 1.4. On the Euro Stoxx 50 in Europe right now, negative 1.5%. And in Asia, very exposed to the energy story, oil and oil product. The Nikkei in Japan down by more than 5%. The Kospi down by 6 off the back of these moves. Brent crude 102.85. That looks like a big gap higher from Friday's close, because it is. We're higher by 11%. It is nothing compared to where we were trading overnight.
Yeah, some 29% higher, $120 a barrel we were talking about earlier in the trading session before a meeting of international leaders coming together to decide whether or not to release some of their strategic reserves that cap how much prices were rising. The conclusion of that just potentially even moments away.
That call is about to commence. And when we get the headlines from that call, we'll bring them to you as we count you down to the opening bell. About 60 minutes away. Let's get you some morning movers. Danny has more. Hey, Danny.
Hey, John. Another part of this world very exposed to energy prices are airlines. Those United and Delta down at least 2.25% this morning. The entirety of the index has now entered a correction as of close on Friday, down 22% from their peak last month. Jeffrey says that for every 5% rise in jet fuel prices, these two companies are going to see a 5 to 10% deterioration in their EPS. Deutsche Bank calling this an existential threat for the airlines. They're not the worst performers, though. The worst performers in the S&P 500 over the past week since war broke out are the cruise line operators. They're dealing with the same dynamics, higher fuel prices and concerns about the consumer. Carnival down another 3% this morning. Norwegian Cruise Lines, that's down 2.5%. Now, the sector that's been benefiting, again, this is to no surprise, are the defense sectors, energy as well. But taking a look at defense this morning, RTX and Northrop Grumman up 1.8% in the pre-market, John.
Danny Berger with the update. Danny, thank you. Looking forward to the programme. Danny and Matt Miller guiding you through the opening bell in about 29 minutes' time. Equity futures, negative 0.8%. Busy week on deck. Headlined by CPI data on Wednesday. And if this conflict continues, that CPI data could look very different in the next few months. Bloomberg's Mike McKee has more. Good morning, Mike.
Good morning, John. It is inflation week. You guys were talking about that with Esther George, and there are a couple of inflation numbers that are important. CPI we get on Wednesday, but we start today with the New York Fed's expectations index. What do people think about the possibility of oil prices in the future? Maybe it's too early because when these surveys wrap up, we hadn't quite gotten into the war the way we have, but it's something to watch. Also, NFIB has inflation numbers in it. The small business folks on Tuesday mentioned CPI on Wednesday. Remember, it carries with it as well some distortions from the government shutdown that may make it come in lower than it otherwise would, and it probably isn't going to pick up anything from the war. But Thursday, we get jobless claims, trade, and housing starts. Jobless claims, the one everybody watching. And then I put this as a separate one, Friday, because Friday's huge. Friday, we get PCE inflation, and that's the one that matters for the Fed. We also get income and spending, durable goods, GDP, second revision, and Michigan sentiment. Now, that's going to be something to watch because that will capture part of the war, not a whole lot of it, but will capture part of it. And we'll see what Americans think about not only inflation, but about their overall mood and whether it has really hurt them. The good news that I have for you, though, is that this is the blackout period and we have no Fed speak. Now until the 18th, we'll be able to sit back and just watch the data without worrying what the Fed's going to do. And I know you were talking with Esther George about this, but the Fed's not going to do anything next Wednesday because it's going to be too early for them to have enough data. But after that, as you said, all bets are off.
Mike McKee, I wonder if that's better news for them than it is for us at the moment, the fact they're in a blackout period. Michael, thank you. Michael McKee, go back to their last statement at the end of January. Available indicators suggest that the economic activity has been expanding at a solid pace. Job gains have remained low and the unemployment rate has shown some signs of stabilisation. Inflation remains somewhat elevated. Can you copy and paste that next Wednesday?
I think if they do, then they'd be in a vacuum with a very different view of the world, because since that report, you've seen 92 jobs eliminated in the latest payrolls report. You've seen inflation expectations in the short-term spike on the heels of oil prices going above $100 a barrel. The scenario looks completely turned on its head to the worst case for them, which is stagflationary shock.
Speaking of turning things on its head, this headline just crossed. I want to bring it to you. Zelensky, Ukrainian leader, 11 states have requested Ukraine's security support. How quickly that story has reversed?
Well, Ukraine has had the opportunity to experience modern warfare. And when I say modern warfare, it's about dealing with drones and drone warfare. There has been a mismatch in pricing between drones that cost a couple $100s to produce and missiles that cost $1 million to produce, blowing them up. And one of the things that the Ukrainians have done is to figure out ways to disable some of those drones. And so they're helping the United States with their efforts. So how much the tables have turned. What this does for the Ukraine-Russia conflict is beyond my ability to really game out scenarios. So on one hand, you've got Ukraine in a better spot with the United States and with other allies. On the other hand, Russia suddenly can sell its oil. So,
sanction relief.
I mean, how do you square this to understand exactly where we are in that equation?
It's really, really complicated. That headline just catching my eye, crossing the Bloomberg right now. Let's turn to the main event this morning. There is a call set to take place any moment now between G7 finance ministers discussing the potential to release energy reserves as crude overnight blasted through triple digits and approached 120. Bloomberg's Tyler Kendall joins us now for more. Hey, Tyler.
Yeah. Hey, John. Good morning. Well, we're waiting for this call to commence, and reportedly it does have the U.S.'s backing as we look to see if there's any potential to bring down and boost the supply of oil. Now, we know that the U.S. would be looking for some ways to help American consumers as the price of oil trickles down to retail gasoline, and the White House has been playing defense on trying to reassure Americans when it comes to the health of the economy. We heard just last week from Secretary of State Marco Rubio that President Trump would convene a council, including his energy secretary and the Treasury Secretary, on ways to help keep domestic prices low. But we haven't gotten an update from there. There had been reporting that the White House was potentially going to ask Congress for a gas tax holiday, but that hasn't emerged either. And then we've seen some other points put on the table, including President Trump last week floating the insurance for those ships crossing the Strait of Hormuz, also a potential naval escort. And then lastly, as you were just discussing, we saw that loosening when it comes to a waiver for India to start to buy Russian barrels. Importantly, people familiar with the matter tell us that heading into this meeting, John, some European nations are concerned that the U.S. is going to ask for a loosening on sanctions when it comes to Russia barrels, just as we're starting to see some of those severe impacts hit the Russian economy.
Brent crude this morning still higher, 102.65, but off session highs. Tyler Kendall there with the latest. Tyler, stay close as we wait for some of those headlines to cross regarding that meeting, that conversation, discussion between G7 finance ministers. Sarah House of Wells Fargo joined us now for more. Sarah, all of a sudden it feels very different. But how much has changed for you and the team with your outlook following this move in energy?
So I think a lot has changed. So certainly the inflation backdrop. So we get CPI later this week, but I think the February numbers are already old news. So we're looking for just the move we've seen already. If sustained this month, you could see gas prices close to $4 a gallon, and so you're talking about inflation close to 3.25–3.5% already in March and in April. So I think it's a big difference in terms of the picture of the consumer. So expecting that to be rather resilient this year with help from some of the tax cuts, but that benefit is essentially wiped out, I think, with some of the moves we've seen in oil prices.
A lot can change between now and March 18th. March 18th, of course, the next Federal Reserve meeting. But let's assume that meeting was today. Could they copy and paste that statement from January, or have things changed that much for them as well?
I don't think they could. I think they're going to have to downplay that idea about the stabilization that we've seen. I don't think it's completely gone out the window. If you look at where the unemployment rate is, it's back where it was in September, and you've seen relative to when they met in January, it hasn't moved that much. But I think where you're continuing to see the weak hiring backdrop, and still, if you look at unemployment on a year-ago basis, it's still trending up. So I think there's more reason for them to be nervous about the labor market picture. And then, of course, you have the inflation picture going the wrong way now. So hard to say that it's only somewhat elevated when you're going back up above 3% here imminently.
Sarah, this feels like a stagflation moment, and this is something that a lot of people have raised. What's the Fed's stagflation playbook?
So the traditional playbook is to look through these negative supply shocks and focus on what's happening in terms of also the demand side. Think about, okay, if you raise the prices once, that increases the level, but that's not necessarily a sustained increase in inflation. The problem, of course, for the Fed is that they've had negative supply shock after negative supply shock, leaving us with inflation above their target for 5+ years now. And so I think they have to be a little bit more sensitive to that upward thrust on inflation coming from this, but it's really tricky given that I think the consumer is in a worse position than where we saw them back in 2022. So I think right now it's a wait and see game. I think they can still try to look through the spike in energy, but it's going to be harder to cut through, I think, just given that they do have that we have seen inflation elevated for so long.
Sarah, it's hard to get a handle on just how quickly financial conditions already are tightening, regardless of what the Fed does. And I'm talking about long end of the yield curve in the United States, in Europe, in the United Kingdom. I just wonder how much that adds stress to an already potentially fragile consumer in the United States, whether that alone is making you reassess what your growth profile for 2026 looks like.
Yeah, it certainly doesn't help if we see tighter financial conditions. I think where I'm more worried about is just that immediate inflationary pass through to the consumer, where gasoline isn't one thing that they can easily cut back on. Sure, there's maybe some discretionary driving that you can see consumers pare down, but I think by and large that this is going to be a stress on their inflation profile. This is coming at a time when, if you look at income ex transfer payments, that's already in real terms close to flat over the past year. And so I think this is really the added strain on the consumer that I think is making it difficult for them to maintain that pace of spending that we've seen, especially given where markets are right now. I think there's some questions over how much of that boost from the wealth effect we'll get going forward compared to what we've had over the past year or so.
Precisely. Sarah, thank you. Sarah House of Wells Fargo. Energy bills were already going to be pretty steep, particularly in the northeast. With this move, you've got the additional gas increase, gas spike as well on top of that. If you were hoping the tax refund story would contribute to a cyclical bounce, and I certainly was hoping that would be the case, those hopes have taken a hit with this action over the last week.
It's going to go to paying for how much it costs to fill up the tank. And this is where it comes to demand destruction. It might not happen as quickly because of the extra cash from this boost, but that won't go towards some of the consumer discretionary that a lot of people were hoping for.
If you are just tuning in, welcome to the programme. We've got stocks set up like this. We're negative about 1% on the S&P 500. Not too dramatic given developments overnight, particularly in the commodity market. For Brent crude and WTI as things stand, we are higher by 11 to 12%, still triple digits, but about $17 off the highs overnight, which is pretty crazy.
It just kind of makes me wonder what people are looking at. They expect this to be short-lived, and they expect some sort of measure from releasing strategic petroleum reserves to sort of stave off any increase in pricing in the near term. Let's see if it sticks. Let's hear what we hear from this call.
The opening bout just around the corner. Still waiting for headlines from that call with G7 finance ministers discussing the release of emergency reserves. In the meantime, let's get you an update on stories worldwide. Here is your Bloomberg brief. NATO defence is intercepting a ballistic missile fired from Iran that was heading towards Turkey. It marks the second NATO interception over Turkey in just the last week. Turkish leadership already warning Iran against actions that could expand the conflict further. Elsewhere, the United States ordering non-essential diplomats in Saudi Arabia to leave after US service member wounded last weekend died overnight, bringing the US death toll to 7. Iran says more than 1,300 people have died so far. Elsewhere, the president not ruling out sending US ground troops into the country. The administration saying it can achieve its goals in Iran without American boots on the ground, but refusing to take the option off the table. The president saying, quote, if we did that, they would be decimated. That is your Bloomberg brief. Up next, we'll set you up for the day ahead, plus Alicia, Levine of BNY Wealth drops by with oil prices surging to 4-year highs. That conversation up next.
Geopolitics by the dip. We've all heard it. We write about it every time this happens. But I don't see a lot of liquidity on the sidelines today. Even individual investors are, increasingly more bullish than our advisors and our surveys. So I think that it's a really unusual time in terms of just kind of catching up to this bull market.
That was Savita Subramanian of Bank of America, not bullish at the index level at all, looking for something like 7,100. I say not bullish considering where everyone else is, looking for a move to 75 to 8K on the S&P. Last night felt like capitulation in the energy market. Is this what capitulation looks like in the equity market, with futures down by 1% on the S&P, on the Nasdaq down by 1.2, on the Russell down by 1.8?
Yeah, we're about 4% from all-time highs. The answer is no. This is not what capitulation feels like, and part of the reason why is because even in the oil market, there is an expectation that this will be short-lived. This isn't going to go on for months and months. When that gets challenged, if that gets challenged, this picture is going to change.
Brent crude up by close to 13% in today's session after pushing 120 overnight. As we count you down to the opening bell, here's the trading diary for the week ahead. 4:30 Eastern Time, the President delivering remarks at the GOP members' issues conference. Look out for that. Tomorrow, earnings from Coles. Wednesday, CPI data. Plus, you will hear from the Fed Vice Chair of Supervision, Mickey Bowman, so look out for that too. On Thursday, Dollar General earnings plus another round of jobless claims and the US trade balance. On Friday, core PCE, durable goods orders, plus UMich consumer sentiment, which if gas prices continue climbing at this rate, that could change very quickly.
It is a pretty direct correlation. Gas prices up, sentiment down. Watch that to be reflected in this survey.
Let's stay on our top story. The price of crude hitting triple digits overnight for the first time since 2022. Alicia Levine of BNY Wealth writing, markets are signaling a temporary supply shock, not economic or financial crisis. Our base case is volatility now, normalization later. Alicia joins us now for more. Alicia, good morning.
Good morning.
What's the path to normalization look like?
So I think you need more panic in the markets. So what you saw in the oil market early this morning at Brent up near 120, 125, as you point out, the S&P is down 2% from the all-time high. So oil up 50% in the week since the strikes, and yet the S&P down 2%. Even emerging markets and international down 7% from the high is not the capitulation. So when this military action was not over in 48 hours, right, and the market still has somewhere in the back of the mind that, the administration is going to cry uncle at some point, so this is going to be quick. I suspect at this point you're going to have to see that quick, sharp downdraft to get it out of the system with oil at 120, and then we probably move on. On the other side of this, you are in a well-supplied world on the energy side. So you have to get through this. Now, whether it's a week or 2 weeks, I would be concerned about 2 months. And then we would change our view here. We would change our view if this went on more than a month or so. Because we'd have to, because then inflation starts getting priced into everything, into food, into consumer products, and on the industrial side.
Then the story's changed.
And then the story's changed because then you do actually bring in the Fed. But at this point, if you look at what's going on militarily, I'm no longer a military strategist, but
sure.
But the drones and missiles are down 80 to 90% from where we were Monday morning a week ago. So you now have this decentralization, which perhaps is annoying, but may not be as effective as we move on. So if you think that, are you in a place where 3 to 4 weeks from now, somebody can claim victory? Probably. But again, this is about duration and this is about time unknown. From here, we would assume normalization later.
At the same time, then do you see opportunities, or do you think it's too early to buy the dip like JPMorgan and Morgan Stanley are talking about?
So there's definitely opportunities here. I mean, the most fascinating thing is if you had reversion to the mean everywhere in every asset class and within the S&P as well. Gold is down 3% from this. The dollar is up 2%. Emerging markets down 7%. NASDAQ is down 1.5%. So when you think about what we came into by the end of February, we're serious, underpricing of U.S. markets versus rest of world, and the dollar very weak. And then all of a sudden you get this reversion. Software is now up 15% from the lows. The semi-software comparison is now reverse. So you got reversion everywhere. I think there will be great opportunities here. I just think that the market hasn't quite priced in. If you're having like a panic in the oil market, you need to also have the panic in the equity market to say, okay, all in.
The reason why I'm asking this is because everyone's saying there will be. There will be.
That's the problem.
Right? So at what point, right? I mean, it's sort of this interesting thing, and yet it's not ever getting there, I guess, because people are all expecting it to be a great buying point. I mean, what is going to be the trigger one way or another?
I think you have to kind of probably get to 6,500 on the S&P here, which I think is probably likely, only because if we're keeping with energy prices over 100 for a week or two, at some point we're going to have a reaction to that. But again, we see it as temporary. Now, what's the risk? What I just said. Everybody thinks the administration is going to have to claim victory at some point if oil prices stay over 100 for long enough. And that the risk is everybody's expecting some sort of backtracking. And then, of course, you get some sort of financial contagion. We don't see it yet. But this is kinetic war, and things can change. We have not changed our asset allocation. We have not changed our view. But we are being very flexible in how we look at things.
Can I just finish on what is temporary? Triple-digit crude is temporary. $90 crude is temporary, $80 crude is temporary. Do you think we actually go back to where we were? That's really my question this morning. Even after a period of de-escalation, does this energy market go back to where it was? Or has something changed because of this development, conditioned by the Chinese who got this right, who stockpiled energy for the last 12 months just in case something like this happened? Doesn't everyone else need to do the same thing even when this normalizes?
Again, this is about duration, right? What's your time frame here? On the other side of this, with Venezuela and Iran out of the sort of axis of evil, as it used to be called, you know, we're in a better supply point.
Oh, you think this leads to a bearish outcome, ultimately, for crude?
No, I think it leads to a bearish for crude and bullish for consumers and bullish for industrial and bullish for markets overall. Yeah.
So there is a moment where there is a tipping point.
There's a tipping point at some point. I can't tell you when that is, but, you know, if you look out, let's call it a year, then we're in a better place.
OK. Alicia, good to see you. Lots to think about. Alicia Levine of BNY Wealth. Not the only one who considers this moment that way, that ultimately things have changed and maybe they change for a more bearish outcome for crude compared to where we were before this conflict.
Well, and this is something even the president has raised himself, the idea that if you do have more stability in the region, should this lead to some sort of resolution, you actually have more production. And guess what? The U.S. is going to be producing that much more, because when prices stay above a certain point, all those oil rigs can start turning on the taps. So it's going to be an interesting dynamic with a lot of whipsaws ahead.
Of course, Jeff Curry of Carlisle sees it completely differently. There's a very, very different view on what this moment means for this energy market.
A structural insurance premium, risk insurance premium, based on the fact that shipping on seas suddenly has new risk. And you have to start to look at that geopolitics degree in a different way. It's something that we keep coming back to. I would love to talk with him more about that.
What is it about spring and Sunday evenings when it comes to financial markets? Regional banking crisis, right?
Can I just say, I feel like it's been every Sunday night since we have started 2025. So I guess on one hand, what is it about Sunday night that always gets me glued to my terminal?
I think I said years ago, the year begins in March.
Yeah.
You know, everyone puts out these forecasts looking ahead to the year ahead. January, everyone gets together and talks about it. You get to March and everything resets.
Yeah.
And resets pretty quickly.
Here we are, doing the same thing.
Here we are. The coverage continues tomorrow. David Tinsley of Bank of America, Kevin Foley of JPMorgan, Abigail Watt of UBS, Jim Karen of Morgan Stanley from New York City this morning. Good morning. Looking forward to tracking these major ruptures with you all week. From New York City, this was Bloomberg Surveillance.